to order. And would you like to conduct the roll?
Ms. Shatmeyer?
Here.
Mr. Sullivan?
Here.
Ms. Cavanis?
Here.
Mr. Parker? Mr. Stevens?
Here.
Mr. Walker? Mr. Knudsen?
Here.
Ms. Harris?
Here.
Mr. Shoemaker?
Yes.
He is here.
Yeah.
And Chair Dirty.
Here. So the first item on the agenda is public comment. Members of the public are welcome to address. Oh, we do have pledge allegiance. So let's,
Oh, yes.
so I'd like to. Tim, would you like to lead us in the pledge?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. So the first thing we have on the agenda is public comment on non-agenda items, and the board is prohibited from taking action on non-agendized items, but speakers are limited to 5 minutes per topic, per person, not more than 10 minutes per topic. So I do have one speaker card here for an item that I think is not on the agenda. Stan Anderson.
Thank you very much, Mr. Chair, members of the board. Stan Anderson from Fort Bragg, Illinois. Fiduciary responsibility. How many times over the past year have I sat here and heard members of this board talk about their fiduciary responsibility to Mendocino County employees? Well, how's that working out for you? Actually, managing the $400 million plus investment fund, you do a pretty good job of following the advice of your investment advisors, Callan, in diversifying the fund over domestic and international, large, mid, and small cap funds, real estates, and bonds. But how are you doing managing the recent contributions to the investment fund by county employees and taxpayers? In fiscal year 2015, the county employees contributed almost $5 million and the county taxpayers $15 million towards the retirement fund, almost $20 million. But between payments to retirees and administrative costs, the association paid out $31 million, selling some $11 million of investments from the retirement fund to cover the difference. In fiscal year 2016, the county employees contributed $5.5 million and the county taxpayers $19 million toward the retirement fund, $24.5 million. But between the payments to retirees and administrative costs, the association paid out $32 million, selling some $12 million of investments from the retirement fund to cover the difference. Over the past 2 fiscal years, because of retiree payments and administrative costs of $63 million have exceeded the contribution of the county employees and taxpayers of $44 million, not one single cent of their contributions has been invested in retirement funds. In fact, the retirement fund has been drawn down by $23 million, and the unfunded liability has grown by $26 million to $205.5 million during the same period. How do you explain that to county employees and still claim you are exercising fiduciary responsibility? The fact is that this board and previous boards have seriously and knowingly underfunded the contributions to the investment fund by setting unrealistic high target rates of return, thereby keeping both the county employee and county taxpayer contributions low and creating a $205 million debt. But that's okay, because the taxpayers, not the employees, will pick up the difference someday. To liquidate the unfunded debt, you would have to totally shut down the entire county for 3 years and use all the tax revenue to pay off your current debt. At your last meeting, you voted 4-3 to continue the failed policy of high target rate, low contribution rate for another 3 years. The same policy has resulted in no contributions to the retirement fund and increased the unfunded liability debt to unrecoverable levels. On a vote as important as that, you should have had a full 9-member board participating. I'm asking that you revisit that vote at your next meeting in June with a full board and reduce the rate to something more reasonable, believe it or not, like 6.25%. Thank you very much for your attention.
Do we have any other public comment on non-agenda items? Do we have any other public comment on non-agenda items? Okay, so the next thing on our agenda is from our meeting held April 19th.
Dan, I would like to move general board comment. I think I sent this out to you and James to the front of the meeting. I have something I think as a 6-year board member, it's pretty important to say.
So we've got a motion.
Yes, I'd like to move the general board member comment to this first place before the minutes.
Okay. Is there a second?
I'll start, so yeah.
Okay. Any discussion? All those in favor?
Aye.
Any opposed? Okay.
Yeah, so my comment, thank you for doing that. My comment is I've been on this board for 6 years. It's been about 10% of my life on Earth. It's been about a little less than 20% of my professional life. If I'm not saying this to wave my own flag, but as far as my credentials, I've been investment. I have 4 degrees that you call it degrees, 2 of them master's degrees that pertain to this. I've been in the business for over 30 years as a financial professional. I've passed a slew of tests, never had a single complaint. I have 3rd and 4th generation personal clients. I have plans I've had since the mid-'80s. So I think as far as any advisor that we see or anybody else on this board, I am qualified to speak to what I'm going to speak to. What happened last meeting, in my opinion, was it was not right. It is what created the huge debt we have in this county. It's what created the train wreck this pension has been for this county, wiping out completely our financial net worth in this county. As a professional, I'll say, if we continue on this path, this plan is going to fail. I'm saying that as a professional, a financial professional. You have told me from the last 2 years, this board, that Wade Stevens, the time to address the target rate is in the triennial report. Every time I've tried to bring up that we have a target rate that's not sustainable, it's not anything that we've been able to meet in the past, it's not anything our investment professionals say that we can meet in the next 10 years. We could, but we can't do it with a 50% confidence level. You've said, gotta wait till we have the triennial experience. We got the triennial experience on Good Friday of Easter weekend. On Wednesday, it was pretty clear that it had not been read by this board to any extent. When I tried to vet the difference between what the actuary said and the investment counselor, you wouldn't have any of it. There was a move to rubber stamp that report without even vetting until I brought it to your attention. You haven't even looked at the demographics. We talked about the financials as I brought it up. But if you were in such a hurry to approve that and close the door for the next 3 years, because I know anytime we try to talk about the target rate in the future, you say you can't do it, you have to wait for the triennial study to be done. So I feel so strongly about this that I'm going to resign from this board unless we bring back into a full vetting this target rate discussion of that report. And if we'll bring it back and agendaize it for action in our June meeting, I will stay on this board. If we're not, I can't be a part of this board anymore. I've worked harder than I've ever worked to try to understand all the moving pieces, to try to help this county get flush with cash on this retirement plan, to stop it from going in the toilet. And to be quite honest, the moral hazard has been an obstacle that has continually put roadblocks in that. It takes, when you have a moral hazard set up like this board with 2/3 of the people, we saw it in the vote clearly last time, that have a vested interest in keeping the target rate very high and the contributions low, where it all inures to the taxpayers and users of services to pick up that debt. It takes an extreme amount of character to be able to live within a moral hazard like that. This board, the moral hazard has ruined the finances of our county. You have the young people in this plan that are putting contributions towards it, and the county is, their sponsor is putting contributions towards their retirement too. It never makes it to the plan. We're using, again, we're up to about, not this report because we had 3 contributions coming in from the county this report, but we're up to about 900,000 negative cash flow. A very substantial part of our earnings were expected in a deeply underfunded plan. The math does not work. We can say, well, we believe our actuary, I asked him point blank, can you show me a plan you've ever had where you've met your estimation? You're telling us it's a 53% confidence level. They've never done it. It's a train wreck wherever you look. So I feel so strongly about the sham that went on in this meeting that unless this board agrees to agendaize that item and give it a full vetting, I'm going to resign from the board. So it's in your hands. And I ask the board at this time to please give the retirement administrator direction to put that, agendaize it for action on the June agenda.
Tim?
Yeah, I voted to accept the report, and I have no intention of changing that. We did reduce the interest rate from 7.25 to 7. We tried to, the actuaries tried to explain that the way they look at investment information is different than the way Callan looks at it. They're doing it for 2 different reasons. The actuaries have tried to say for years that they don't follow the same procedures as investment managers. They also said that the information from Callan is only one little part of the big database that they get from other investment managers, that we shouldn't be trying to compare Callan to what SACRS does. But we talked about last month that an actuarial report is a lot of educated guesses on what's going to happen in the future. And we even said we had some very educated guessers that were doing the guessing, but it's still guessing. There's mortality tables that are used. There's a number of disabilities we're going to grant. There's a number of people who are going to retire. A number of people are going to die.
Tim, we're only talking about financial, not demographics.
I said silently.
Financial targets.
I said silently while you denigrated this board just a few minutes ago. You can sit silently while I give my presentation. Any one of those things I just mentioned could have a larger effect on the outcome of this system as the thing you're objecting to. They're all guesses, nothing more than guesses. I've sat here quietly while you've called our actuaries, who actually, Paul Angel is one of the best known actuaries in the country, and you've called him a liar. Again, I'm going to stop talking now. I have no intention of changing my vote.
Okay, let's call on the council, Jeff, to advise what would be required by the board to reconsider an item.
So I think what Trustee Stevens is asking the board to do is to reconsider the vote that was taken last month. And so there's 2 requirements for a motion to consideration. One requirement is very clear, the other one is a little bit ambiguous. And maybe we don't need to get to the second one if you don't pass the first one. So a motion for reconsideration can only be motioned by somebody who voted for the acceptance and approval of the actuary's report. So it was a 4-3 vote last month. So one of the 4 of you who voted to approve that report would have to make this motion. The second piece that's a little ambiguous is whether it had to have been made at last month's meeting. I think I could make an argument if we need to that we don't have to be so rigid. The idea behind this rule is that when the board takes action, there's this concept of finality. And that, once you make a decision, that's the decision, now it's time to move on. So if somebody in the 4 who were in the majority last month want to make this motion, that's the only way that the board can consider and vote on a decision whether to reconsider, and then presumably next month you'd come back and have the actual.
Does the second have to be from
No, the second bit can be from anybody.
Richard?
Isn't there a third, if you were absent at the last meeting, you could call for a reconsideration?
You know, I've heard that. I don't know that it's explicitly stated that way in Robert's rules. So I guess there would be one person who was absent from the vote who's here today, and I guess we'll cross that bridge if we need to.
You've never hit on a long-term basis a 7% net investment rate of return. So you're adopting another rate, it's 7%. We've never hit it historically. You certainly haven't in the 10 years in the rearview mirror. We're not, our capital market expectation from our investment advisor suggests a 6% rate of return. Though what we have from our actuary is 25 basis to 100 basis points too high. I speak to that as an investment professional. We had the wrong information from our actuary last time. He told us that we had hit it on a 5-year basis. We had not. We had Greg, and he was somewhat blindsided by that. It's not really fair to him, but when I was trying to vet the investment expenses, he's speaking to it from his standpoint, saying it's net of investment expenses on his capital market expectation report he did. But we had Stan and James sitting in the audience knowing very well we have about $300,000 in expenses that are not included in Callan's. And for all practical purposes, when you look at Callan's number, you have to subtract 40 basis points for administration and investment expense. And so there was information in that meeting that was given out that's incorrect. If we do a vetting, we'll see that you cannot substantiate the rate you have adopted. And as I said, as an investment professional, and as I think I'm qualified as any other advisor you have anywhere else, I feel so strongly about it, unless one of you makes this motion and we agree to vet it. I don't say you have to change your vote when we go to vote, but we have to give it a full vetting in the light of day. If you don't do it, I'm going to get up and walk out of here. I'm going to leave this board. I've dedicated, as I said, 10% of my life, almost 20% of my working career, to understanding the moving pieces. There were people in this last meeting that they can't imagine understanding where or how Siegel does this work. Let me tell you, I think I understand the moving pieces pretty well on the demographics. I certainly have ownership on them from a financial standpoint. And the only thing I've asked about bringing back in is the financial component. So that's where it is. So if someone makes a motion and we agree to bring it back, I'll stay on this board. Otherwise, I can't do this anymore because it's such a sham. Someone want to bring Craig up to speed on
Yeah,
what we're
so I'd like
discussing?
to, sorry, good morning. So what we have is we've moved board discussion items to this part of the agenda at the beginning, and Director Stevens has raised his concerns about the rate of return that was adopted on a 4-3 vote at our last meeting. And it's been clarified that to reconsider an item, either one of the people voting for who had been majority need to make a motion to reconsider and put it back on a future agenda. It won't be on today's agenda, it'll be on next agenda. Or it's a little ambiguous, but I would rule as chair that I think one of the 2 board members who were not present and voting last month on that item, which I believe were both you and Jerry, could also make a motion because we're voting once. So what we have is a request that a board member who voted for or who did not vote to make a motion to reconsider and place this on our next month's agenda. And if that doesn't happen, then there's a motion and we're going to go into the rest of the agenda.
Thank you.
So we have a motion.
Okay, thank you. Thank you very much. I'll leave this with you if I can turn it off.
If I may, Mr.
Okay.
Chairman. Mr. Stevens, if I may, is it your intention at this point to resign from the Board of Retirement?
Yes.
Okay.
Yeah, I can't, as a financial professional, it is so egregious what you're doing and so wrong that I cannot be a party to this board. So if this board won't even consider fully vetting something like that, sorry, I just can't. It's such a train wreck that I can't be a party to it. And I've dedicated a lot of time to this. I've dedicated a lot of time to make sure I understand the moving pieces. It's not easy for me to get up. I'm not a quitter. I think Gail, who's been with me forever, would say that I don't quit, that I've always been successful in my endeavors. I've tried as hard as I've ever tried to fight this moral hazard. It's unbelievable. And there's no question that this plan is going to fail. And I wish I could be part of making it work. I wish I could be part of making it work for this county. I wish I could be part of making it work for the employees of this county. But if you won't even come back and fully vet, it's so ridiculous that I can't be party to it. So thank you very much. Here's my equipment.
Thank you.
So we did have public comment on non-agenda items, but I'll entertain, we'll keep it quick, but maybe to 5 minutes for comments on this item. Ken, I saw you raise your hand.
Well, I've been to a number of these meetings, and I've watched Ted, and he always seems to be the contrary person, if you will. If you look in the rearview mirror that he keeps referring to, there's nothing but a disaster. We've never met any of our criteria. And I don't care what the actuary says. The proof is in the pudding. And the pudding is coming out wrong. We've been upside down time after time again to 200 million. Ted's asking for something that's very realistic. 2 board members were missing last time. They couldn't vote. It wasn't vetted properly. He seems to be the Lone Ranger, almost the Lone Ranger, in trying to acquire some discipline to this board. And the very fact he's leaving, you should all be ashamed. Here's a guy that brings something to the table that you don't even listen to. And you're completely wrong, by the way. I don't know what's going on in the background. He talks about the moral hazard. I think that's the reasoning behind all of this. You guys can't vote on something that might take something away from you. I look at the employees in this county, they're going to get screwed on this thing, ultimately. And so are you guys, all of you. So I'm going with Ted. I'm out of here.
Yeah, I'll make it short. So you accepted a 7% annual return over the next 3 years. So the other day, John Bogle, who's an expert, pretty good authority, is projecting over the next 10 years for this country the market return somewhere around 3 to 4% average. Now, I don't know what your actuarial, what expertise he has that exceeds that of John Bogle, but as far as I'm concerned, you've created almost like a fantasy land in terms of market return. And the damage to this county is going to be enormous. It already is enormous, but it's like a rolling train wreck that just gets worse. So thank you for the time.
Okay. So now we go on to the. Oh, okay.
My name is Richard Respedy. I was born and raised here. Myself, my wife, my friends and neighbors, a lot of you, a lot of these folks are the citizens of this county. We're the people who employ the folks who work for the county. We are also the people who expect you as a board to implement a basic concept that the normal contribution will fund the promises we make to the employees in a timely manner on a break-even basis, 50-50. That doesn't seem to be happening. It's getting worse. I thought Ted was a good shot at maybe turning it around over time. I'm very disappointed that we lost him. And I'm sorry that you folks have done this because I think you basically set the stage to ruin the quality of life in our county. Thank you.
before we go on, we're still talking about, I mean, we still have the comment from the board.
Board member comments.
Yeah, I wanted to bring up something that kind of was touched on last month when the assistant CEO, and I can't remember his name.
Alex Laura.
Yeah, was here, and he made a statement, and I asked him if he knew how much of the county's contribution to the retirement system comes from grants. Money comes in from outside of the county. And he answered it from the other direction and said he thinks some 50% comes from the county general fund, somewhere in that area. That means that 50% or more, I wanted to touch, the court's contribution all comes from money outside of the county. It all comes from Sacramento. The courts are responsible for the finances of the state is responsible for the finances of the courts. So well over 50% of the money that's going into this retirement system doesn't come from the taxpayers of Mendocino County. It comes from the taxpayers of the country and the state of California, but it doesn't come directly from Mendocino County taxpayers. I don't know if many people know that, but I think it's an important thing to bring up. And then the last thing is that I look at, and Greg will be talking about this, as I look at the report we're going to get from them a little later on, our average return for the last 7 years is 8.17. Am I reading that right? So at least over the last 7 years, we've beat our target return. It's not a lifetime, it's not a 50 years like the actuaries work with, but we do beat it occasionally. And I think some statements have been made that we never do. Well, we do. And we have in the past.
Do we have any other board member reports?
Yeah, I think I'd like to comment since I was the person, and I said at the start of the meeting last month that I had to leave at noon because I had a class and it was the last one. And I did leave at noon. However, I have some experience with actuaries, with other actuaries. There are only about 5 nationwide, highly respected actuaries in the U.S. who deal with pensions. I believe it's our board's challenge to bring to the table the best experts we can and to fold in what those experts say as we make our decisions. Getting dry mouth, that means I'm winding up and I don't want to. As we sit here and we consider decisions, many of those decisions are limited by the 37 Act. Many of them are limited by law. The people who sit around here, regardless of what we have done in the past, whether we have a connection to the county or we don't, make the best possible decisions that we can. I've seen board members who will be affected by decisions that are made by this board vote, as with the COLA last year, to lower what would be their retirement because they are acting as fiduciaries to the members of the plan and to the fund itself. Pardon me, it's been really tough to sit here for 2 years and every single meeting hear the same thing. We do make the best decisions we can. I respect the people who sit around this board. I have a great deal of respect for the people that we bring in, and I think we make the best decisions we can for the employees and for the county. And you don't bring back a vote, because then you'd be bringing back votes all year, many years. You don't bring it back. It was made, and we go on.
And I just want to say one thing. I stand by my 10 minutes I talked last month. But the one thing that I think everybody should know is we are having an actuarial audit. That is something we are going to do. So we're going to find out how these actuaries do. And that's something I think that's important. That's something that this board was committed to from past mistakes with Buck. And so, but I stand by everything I said last meeting. It's about balance, and we are getting lower. This will be a 1% drop from, you know, probably the last 5 years. I mean, we are getting there. It's a balance. This is a long-term plan. So.
Okay, so we're gonna go on to consent calendar, which,
Mr. Chairman.
minutes, the board for April 19th. Do we have any requests for changes to the minutes? If there's no request for change, we'll adopt it by consent. Or by
Unanimous consent?
unanimous. Yeah, I'm not seeing any suggested changes. So then we're on to the consent calendar, which is the April 2017 retirement report.
Just real quickly, I see one of the retirees only had 2.5 years. Is that a reciprocity issue?
Okay. Then we're on to item number, so consent or approved by, I'm not hearing any opposition, by consent we'll approve the consent calendar.
Thank you, gentlemen.
And so then we're on to item 3, which is discussion and possible action regarding the investment matters. First we have quarterly investment report.
So maybe I'll just give a quick introduction about what we're going to be doing for the next few hours. We've gone through and we've taken a look at your broad asset allocation in each sub-asset class. We did a lot of work with international equity, and we decided to do 2 things with international equity. Add a dedicated emerging market equity manager, and then add a dedicated international small cap manager. So now we're at the point where we need to pick which managers we're going to fund. So we did some search work, and at the last meeting we mentioned to you that we're going to bring in 3 firms to interview today. And your charge today is to decide which one of these 3 firms is the best fit for your investment program. So we're looking at emerging market equity firms, managers today. And there are 3 of them that we're going to talk to. That I think you all might have a little agenda that looks like this. It's my understanding that given time constraints, we're going to cut them all back to 30 minutes to try to keep us on schedule today. And the 3 firms are Dimensional Fund Advisors, goes by DFA, Investec, and Westwood. I think as you listen to them today, you'll see that all 3 of them, while they all invest in emerging market equities, they all do it a little differently. And the few areas where they're going to differ are the amount of active risk they take relative to their index, high tracking error, low tracking error, very risk aware. Their fees correspond to the level of active risk. So the ones that take a lot of risk are more expensive than the ones that are very risk controlled. And performance, so looking through the rearview mirror, the ones that are the most, have the highest level of active risk have performed better than the ones that are more benchmark aware, that have performed a little more closer to the benchmark, as you would expect. So I think at the end of the day today, the selection of these 3 managers might be based on, well, how much active risk do we want to take with these managers? Now, all of these managers invest in emerging market equities. The asset class in itself is volatile, we know that. So this allocation is 10 or 15% of your total international equity, which is 20% of the total. It's about $13 million of the $400 million, roughly. So it's just a percent of your portfolio, and then we're asking, well, how much risk do we want them to take around that 1% of the portfolio?
If I may interrupt very briefly, Greg. Trustees, for your information on the agenda, there is an attachment that was put under Domestic Equity Transition Plan. That is Callan's research overview and comparison of these 3 plans. So there's a lot of information in there that puts the 3 side by side so you can see different metrics kind of on different graphics for those 3. Just wanted to point out that I didn't get that in the right place on the agenda.
So,
Okay. Do you have any questions before we bring the first firm in and have them start telling you what they do and how they do it?
Will they directly speak to the risk that they take, or is it something we're gonna have to kind of figure out?
It'll certainly be implied, but sometimes these firms, what we counsel all of them is to make sure they're talking to you and not just showing how smart they are, right? And actually communicating with you. And so if there's ever a point where you're not getting something you feel like you need, just ask the question. But the level of active risk, DFA is the lowest, then Investec, then Westwood. DFA is very quantitative and risk-based. Investec does have a quantitative feature up front, and then Westwood is very fundamental, bottom-up, third-party securities. So that's the funnel there. Okay. Any other questions? Okay, great. Craig, do you mind if I sit next to you here? No, no. Maybe. Mind if Alina sits next to you?
I think I'll let Alina.
She wants to stare them in the eye.
You get them, Alina.
Stare them down.
That chair doesn't be very Morning.
I know James had mentioned that you wanted us to kind of keep it to 30, still keep it to 30, or try to get you stopped at 9:30?
30 minutes.
Okay, sure, we'll do that. Well, thank you so much for inviting us here to compete for what I understand to be Mendocino's first dedicated exposure to emerging markets. And hopefully over the next 30 minutes, you'll see why we believe that Dimension will be a great choice for you all to and a partner in that space and in your needs there. I am Ted Simpson, and working with our clients in California, or with Dimension for about 15 years, and currently work with our clients in California, including about a half dozen or so California counties that use Dimension for emerging markets as well. As well as, I'm joined here by Mitch Firestein, who is one of the senior members of our non-US equity investment team, specifically focusing on emerging markets. So with that, my plan was just to say a few words about Dimensional as a firm, and kind of understanding kind of how we approach things, but then really turn it over to Mitch to get more deeply into our overall view of the world and how that plays out in a very process-driven, team-based approach that we use to manage emerging markets assets for our clients. So Dimensional is a very stable, growing, privately held firm founded in 1981. We're headquartered in Austin, Texas. Mitch and I are out of our Santa Monica office, which is where the firm was kind of primarily first headquartered. At a very high level, Dimensional is the firm that is trying to beat the markets for our clients, but trying to do so without outguessing the markets. So Mitch will get into more details of what that means, but I'll explain that kind of just in a thumbnail. Common understandings and robust academic research have shown that it's very difficult to pick stocks and time markets on a consistent, reliable, and most importantly, profitable basis. And so instead of taking that approach to adding value for our clients, instead we use robust academic research, which has shown different characteristics within stocks and even for some of our clients within bonds that have different expected returns, just like stocks have higher expected returns than bonds with different characteristics. Mitch will get into more details on that. And then what we do is we tilt our portfolios, overemphasize those characteristics, and we do that in a very transparent way so that our clients can understand what's going on when when we beat the markets and when we don't beat the markets. And so it's very easy to kind of follow along that way. Also, we have a value added coming from a very flexible and patient approach to implementation, which is very important in emerging markets, especially given the trading costs there can be very, very difficult. Trading costs can be very high. And so I would say that, the last thing there I'd say is we're doing all of that at a very low cost of overall ownership, starting with a reasonable management fee of 47 basis points, a total expense ratio in our emerging markets core equity strategy of 53 basis points. And then on top of that, a big focus on these other less observable kind of implementation or trading costs, which again can be very, very important in emerging markets. So with that, there is in that first tab of the book, I see all that you have in front of you. There's additional details on where our offices are located, some of the Nobel Prize winners and other academics who work with us very closely as consultants, another Nobel Prize winner on our fund board as well, and also the team that makes up this, or the people that make up this team-based approach that I mentioned. But unless there's specific questions on that, in the interest of time, I think I'll try and make a niche to get more deeply into that investment philosophy that I kind of touched on using the academic research, and then specifically how we apply that view of the world to managing our emerging markets total market, what we call core equity solution for our clients.
Great, thanks Ted. Good morning everybody. I'm going to start off talking about our investment philosophy. We don't talk about our portfolio and how we design it and implement it. And then I'll follow up by talking about performance. Please stop me anytime if you guys have questions. Hoping to make this as interactive as possible so you guys can fully understand what we do and why we do it. Hopefully you guys all have the materials that we sent. I'm going to start on page 10. And this is really the underpinnings of every portfolio that we invest in at Dimensional. As I said, we manage about $500 billion across many different asset classes, but we use these underpinnings that are based in academia to construct our portfolios. And what I mean by that is when we're constructing a portfolio, one of the most important parts is to identify the dimensions of expected return. So there's been decades of academic and empirical evidence that have shown that there's 4 premiums in the marketplace. They're listed on this page. It's the market premium, stocks outperform the risk-free rate. Small companies tend to outperform large cap companies over long periods of time. Value stocks or low relative price stocks tend to outperform high price stocks over long periods of time. And lastly, higher profitable companies tend to outperform lower profitable companies over the long term. Now, according to the Journal of Finance, there's over 300 different premiums. So you might ask is, why are we only focusing on 4 then? Well, we believe to become a dimension or a premium that we're going to target, they have to pass over certain hurdles. And those are listed on the right side of the page. For example, the premium needs to be sensible. If you sort stocks in the United States according to the returns, you're going to notice that companies with that start with letter A tend to outperform. Well, are you going to base a portfolio on that? No, that doesn't make any sense. That's not based in anything. It's not logical. So we want to make sure that these premiums make sense. They're logical. We want to make sure that they're persistent over different time periods. We want to make sure that they're pervasive over different asset classes, regardless if it's in the US, international, or emerging markets. We want to make sure that they're robust. And what I mean by robust is if you use financial ratios, so for example, we use price to book to see if a company is cheap or expensive, we want to make sure that the same thing is going to apply if you use a different financial ratio to see if a stock is cheap, like price to earnings, price to cash flow, other metrics out there. You want to make sure you get the same result. And last, and maybe most important, is we want to make sure that they're cost effective. And what I mean by this is if you have a premium out there and you have very high turnover in the portfolio, you might wipe away all the gains you're trying to capture just by trading. So we're very cost conscious in all of our strategies, and including especially in the core strategy that we're going to talk about today. So for our proof statement is on the next page. And what we have here is we took as much data as we could possibly get. So in the US, we're going back to 1928 to present. And in emerging markets, because that's what we're going to focus on today, we're going back to 1989 to present. And that's going to be in the right column. What we did here is we looked at small companies versus large companies on the top right corner, where it says size, emerging markets. And you're going to notice that small companies have outperformed large companies. And if you go down one row to the middle row on the right side, you're going to see that value stocks have outperformed growth stocks. And the same thing is going to hold true for higher profitable companies versus lower profitable companies on the right side of the page. So we're going to structure our portfolio to capture these premiums in the marketplace. Now on the next page, what we did here is we took the calendar year premiums in the marketplace. So going back to 1989 in emerging markets, we're looking at the market premium on the top row. The second row is going to be small companies versus large companies. Third row is going to be value stocks versus growth stocks. And the last row, highly profitable companies versus low profitable companies. What we're going to see here is that there's some volatility. There's blue bars and red bars. Some years there's positive premiums, some years there's negative premiums, but there's more blue bars and red bars. So we expect to be rewarded for having these premiums, but they don't necessarily show up every year. But there tends to be more positive premiums than negative premiums. But if we look at, let's say, a 5-year rolling period on the next page, on slide 13, you're going to see what we have here. It's a 5-year rolling period of each of the premiums, and you're going to see that there's a lot of consistency in these premiums over longer periods of time. So if you structure a portfolio to target these premiums, the investor should have a good experience. And that's what we've seen. So that's our investment philosophy. I'm going to switch gears and talk about the portfolio, unless anybody has questions about the investment philosophy side. Okay. Great. Moving to slide 15 now. So Dimensional has a very long track record in emerging markets. It has one of the longer track records for investment managers. We've been trading in emerging markets since 1993. So a long track record dealing with these very complex and very dynamic markets. The portfolio we're going to talk about today is the emerging markets core portfolio. This is going to be an all-cap strategy. What I mean by all-cap is it's going to hold large cap stocks all the way down to micro cap stocks. So we're going to hold stocks that are worth $50 million. Also, the portfolio is going to be style-wide. What I mean by that is it's going to hold growth stocks and value stocks. However, it's going to emphasize, it's going to overweight those lower relative price names or value names, and it's also going to overweight small companies and overweight the more highly profitable companies. So everything I just talked about on the previous page, we're going to emphasize those names, but it's going to hold every name, or most names in the market. And the things that's going to jump out to you on this page is the number of names this portfolio holds. There's over 4,600 different securities. And that's important for 3 reasons. 1, diversifies away individual security risk. The largest name of this portfolio is about 3%. 2, it's the most reliable way we know how to capture the dimensions of expected return that I just talked about on the previous section. So what turns out to drive these premiums, that drives the small cap premium, drives the value premium, are really a subset of value stocks or a subset of small cap stocks on any given year. Well, there's a couple ways to go about this. 1, you could try to pick that correct subset of value stocks, for example, which is very hard to do, but if you do, you're going to knock the cover off the ball. But it's very hard to do over a long, consistent basis. Or 2, do what we do. We buy most of the value stocks, buy most of the small cap stocks. So when these premiums appear, we're able to capture it. And when these premiums appear, they tend to be very quick in terms of their appearance. So for example, in 2016, the value premium was very strong in emerging markets. And it happened very quickly. It happened in a period of weeks where we saw major outperformance in value stocks. Well, if your portfolio drifted, didn't focus on those value stocks, you might have missed it. So every day we're going to make sure that the portfolio is focused on the dimensions of expected return, those small cap, value, more highly profitable stocks, and overweight them in our portfolio. And the third reason why we have so many number of names is our trading philosophy. And what I mean by that is because we have so many different names in the portfolio, when we go out to the marketplace, I'm going to give our traders not 10 names to trade or 5 names to trade. I'm going to give them a basket of 300 or 400 different stocks on any given day that I'm willing to buy. They're not going to execute 300 or 400 different names. They're going to go out there with their flexibility and look for more aggressive traders out there in the marketplace. People that are willing to cross that bid-ask spread and save us money, that implicit cost that Ted was talking about, that friction.
What spread?
Bid-ask spread. So what that means is...
Bid-ask.
Yeah.
Okay. Bid-ask. What's a bid-ask?
And we're able to have lower impact or no impact on these stocks and not push them in price. So on the next slide, on slide 16, we are showing a single country example of how we construct the portfolio. The portfolio invests in 21 emerging market countries. And what we're doing here is we're taking the emotion of stock picking. So in every country, we're going to sort stocks according to their market capitalization. And then we're going to overweight those that are in small cap. We're also going to sort the stocks according to their price to book ratios, and we're going to overweight the lower price to book stocks, the cheap stocks in each of these markets. And the same thing we're going to do that for profitability. So the end result is sort of a 3D dimension on a 2D page on 16. So you can see that there's darker shading on the bottom left-hand corner of the chart. What that's saying is those small cap value stocks are getting a lot more weight than, for instance, those mega cap growth names. So we're taking weight away from those mega cap growth names and we're migrating that weight to small cap and to value names. The end result is on the bottom of the page in terms of characteristics. The portfolio is going to be much smaller than that of the benchmark. It's going to have a lower price to book. It's going to be cheaper than that of the benchmark. And it's going to have about the same profitability ratio as the benchmark, which is a little deceiving because I just went over how I said we're overweighting those more highly profitable names, but growth names tend to naturally be more profitable. Small cap and value names tend to be less. So as we're overweighting those value and small cap names, those names tend to be less profitable than those mega cap growth names. And
so when looking at investments in especially emerging markets, do you ever find that in some countries there may be less transparency about how income and expenses are reported?
Yeah, so we look on a country by country basis when we do our sorts, when we do our process-driven approach. So we're comparing apples to apples and not doing cross-country comparison of income and balance sheets. So that's the first thing. The other thing is that we believe that the market is pricing these companies fairly. There in each of these countries that we invest in, we make sure that they're on various exchanges that we approved previously, that they make sure that they have reporting requirements. Most of them have standard international accounting practices. But we believe that the market is pricing these companies fairly. The market price is a fair price.
I'll just kind of reiterate that. Even like in America, we don't invest our U.S. companies in, say, like the pink sheets and some of the exchanges, similar type of things, often in emerging markets. So we're going to have a pretty high bar, not just with this quantitative approach to identify these things, but also to qualitatively make sure that it's the right sandbox, so that our view, this kind of Professor Fama, Gene French view of the world, kind of does play out, because there are certain places in private markets, in pink sheet type markets, that doesn't actually play out. So we exclude those.
To show you an example of how the portfolio deviates from that of the overall market, on the next slide, slide 17, we put the portfolio weights in a 3x3 grid in comparison to the MSCI Emerging Markets IMI Index, which is, according to MSCI, which is one of the benchmarks, 99% of the investable universe in emerging markets. So we're going to have value stocks on the left-hand column, growth stocks on the right, large cap on the top row, small cap on the bottom row. The blue or the teal section, that's going to be the weight, where you see the percent. That's the weight that the portfolio has in that segment of the market. That gray bar, or the gray percentage, is what the MSCI Emerging Markets IMI has. What you're going to see is the portfolio is going to have more weight in that value column, and it's going to have more weight in the small cap. So you can see how the portfolio is emphasizing the weights of that small cap and value side. Also, we included in each of the segments of the market, those 9 boxes, the profitability that the portfolio has versus the profitability the benchmark has. You're going to see that the portfolio is going to have higher weights of profitability in each of those segments. So you can see how the portfolio is emphasizing those more highly profitable names in each of the areas. Another way to think about it, think of an ice cube tray, and we fill water in each of the cubes in the ice cube tray. And we have growth stocks on the left side, value stocks on the left side, growth stocks on the right side, large caps on the front, small caps on the bottom. All we're doing is we're just taking that ice cube tray and we're just tilting it back. So it's going to the small caps and going to value stocks. That's what we're doing in the portfolio. Now we have a few more bells and whistles we put into the portfolio. On the next page, on page 18, we want the portfolio to be as diversified as possible, but we want to make sure it's focused on dimensions of expected return. And so by doing that, we're not going to start with just the index constituents. Instead, we're going to take every stock in each of the 21 emerging markets that we invest in, and we're going to apply exclusions to them. We have some of them listed on this page, on page 18. So for example, we exclude REITs. REITs are a pretty small part of the emerging market universe. They can be very interest rate sensitive. They don't act necessarily like other equities, so we're going to exclude them from the portfolio. And we have a couple others that are listed here. In addition, when I create the basket of buy names or sell names that I want to give to our traders on any given day, I'm going to apply a momentum filter on top of it. And what I mean by momentum is that stocks that tend to outperform keep on outperforming, and stocks that have underperformed keep on underperforming. So what we're going to do is we're going to delay buying a stock that is exhibiting negative momentum. Now, why is that important? Well, stocks tend to become value or small cap when they decrease in price. So we don't want to catch the proverbial falling knife. Same thing on the upside is when a stock is exhibiting positive momentum and beating its peers, it's going to go from small cap to large cap or value to growth. We're going to delay selling that name, ride that momentum out, wait for it to subside on a relative basis, and then sell out. As I said before, we're in no rush to buy or sell a name because we have over 4,000 names in this portfolio, and we have that flexibility to have that slight delay and make sure that the portfolio's characteristics are that of what we desire, which is smaller than the benchmark, more value-oriented, and more highly profitable. I'm going to jump to slide 20 now. And so that's how we go about constructing the portfolio. But we also want to make sure when we implement the portfolio, when I say that, when we buy or sell, we want to make sure that we're very cost conscious. So to simplify things, we broke down trading costs into two things. One, explicit costs. This is what you normally think of when you trade. Commissions, stamp duties, exchange fees. You trade, there's no way around it, you're going to pay. Turnover in this portfolio is very low, between 5 and 15% on a given year. So that's one way we can keep it low. The other way is we have our own traders across the globe, here in California, in Santa Monica, Austin, Texas, Charlotte, London, Tokyo, Sydney, Singapore, where we are using a broker's pipelines to access the market. It's called direct market access. It's using their pipelines. We're using our own traders that are sitting in our offices around the world, actually buying and selling the stocks. Why is that important? Well, it aligns the portfolio's incentives directly with that of the traders. So the traders know they don't have to trade if it's a bad trade. They want to make sure it's the best thing for the portfolio. If you outsource it and you go to a broker and you say, I want to buy $1 million worth of stocks today. Well, guess what? They're going to execute $1 million worth because that's the only way they get paid is through commissions. This way, the traders go, today wasn't a very good day. Those 300 buy names we had, we were only able to execute 10. It was only $500,000. Not a big deal. We keep cash balances very low in the portfolio, about 10 to 30 basis points on average. So very little cash drag. So we're able to reduce cash drag and stay focused on the dimensions. So at any point in time, we're giving our traders that flexibility. But the other part of trading costs, and maybe most importantly, is the implicit side. And what I mean by that is, when I talk about implicit trading costs, it's really a market impact. When you buy or sell security, it's a zero-sum game. And what I mean by that is, it's the market impact is the effect a market participant, a trader has when they buy or sell a name. If you buy if you buy a name, there's going to be a winner and loser. So when you buy a name, you might push a stock in terms of stock price because you want it badly. So you're going to cross that bid-ask spread I talked about. If you're a buyer, you're going to cross it and you're going to pay the asking price. What we do at Dimensional is, though, we wait for maybe those more aggressive traders to come and play. Say, okay, we're going to sit on that bid. If you want it so badly, we'll sell it to you, or we'll buy it from you, but we're not going to buy it at your asking price. We'll buy it at the bid price.
Do you lend securities?
We do lend securities.
How much of the portfolios?
It varies on
average.
It's about 10 to 20% of the portfolio is.
I want to make sure we have enough time for questions and if there's portfolio construction. You only have about 15 or 18% in China. China is about 26% of the index. All of the managers we're meeting with today are underweight China. I want to compare and contrast why you're that way. So why are you up at that China level?
Sure. So we, if you want, we have all of our country weights listed on slide 25 for the committee. We cap our countries at 17.5% at time of purchase. So you'll notice that Korea, China, and Taiwan are going to be hovering around that 17.5% mark. The reason why we cap countries is not a performance optimizing move, it's a risk control measure we have in place. We've seen countries such as Malaysia, Korea, Mexico run up to be 25, 30, and 35% of the emerging market universe. Well, those weights have been taken care of naturally. Asian currency crisis, Mexico peso devaluation. We want to make sure that doesn't happen in the portfolio. We recognize that there is a higher political risk in emerging markets. That's why we cap these cap countries at 17.5% as a risk control measure. Now we will increase the cap if there is some structural change that happens in the marketplace. We're not going to chase it based on country performance, but if more securities come in, we add new countries, increase in free float, we'll discuss increasing the cap. But right now we do have that cap. It is going to mean that we're going to be underweight Chinese securities.
And all those decisions, none of those decisions, quote unquote, happen on the desk. Those are all at our investment committee level because this is so much of a process-driven approach. And some big changes are even kind of at what we call an investment policy committee level, which includes folks like Professor recent Nobel Prize winner Gene Fama, others like that. And you have to kind of come in and present your ideas for change, almost like you present a PhD dissertation, and he doesn't give out days easily.
I'm going to jump to performance because we're running a little short on time now. I'm going to go to slide 28. This is our performance On the top part of the slide is our trailing performance as of quarter end. The portfolio's returns are net of fees compared to that of the MSCI Emerging Market Index, which is primarily a large and mid-cap index. And what you're going to see here is the portfolio in the trailing quarter, 1 year, 3, 5, 10 years has outperformed by over 100 basis points net of fees. On the bottom side of the chart, we have the performance on a calendar year basis, so you can see each year for the last 10 years how the portfolio has performed. The portfolio gives broad diversification of the asset class in a value-add approach. We have a very transparent process with widely accepted premiums in a very cost-effective way. So instead of the ability to outguess the market with a small handful of names, we're really doing it using market information and applying that into the portfolio. So we're grounded in economic theory, and we've been able to outperform the market over various market cycles. And all of that with a pretty reasonable management fee. As Ted was saying before, the expense ratio is 53 basis points for the portfolio.
No Vietnam.
No Vietnam. So Vietnam is considered a frontier market. We don't invest in frontier countries at dimensional or in the stretch.
So frontier is?
So frontier would be kind of like the junior ranks of emerging markets. So you think of like Sri Lanka and some of the Arabic countries, Vietnam, for example. Argentina is a frontier market.
Any the big California funds, CalPERS, CalSTRS, investing with you?
Yep.
Let's see, CalSTRS currently does on their defined contribution plan invest with us, and CalPERS has been in and out with us over the decades, but with a lot of their move to internal management, they are not currently client with us. A lot of the California counties are with us, and yeah, and especially with across our strategies, but I just happened to sit there this morning at breakfast and went, wow, there's 6 of the counties that are with us in emerging markets, a few more cities and other kind of government entities in California as well, in emerging markets.
Just to clarify, that's 6 of the 37 Act counties? Or
let's see, one of those is a large city and county just out here.
Yeah.
I think the other ones are SACRS counties.
I had one other question. I think I caught it. So you folks stay fully invested? Okay.
Yeah, so our cash balances are very low, about 10 to 30 basis points. So we're staying focused on the asset class.
Yeah, the page you're on is probably the most indisputable kind of premium, which is that stocks beat bonds. And then this is not exactly analogous to just extending that, but it's a similar concept. And so we don't want to have cash drag and the market takes off, and now's the time that we either had cash drag for operational reasons or we were betting on cash. Cash doesn't pay much.
Right. The 1989, the history going back to 89, what's significant about 1989?
That's as far back as we can get reliable data.
Okay, the data, yeah. And you can see it developed markets, it goes back longer, and then in U.S. markets, it goes all the way back to the 20s, and frankly, even different parts of data are even, we just had one of our professors come present to us taking profitability, which had only gone back to like the 60s, and he just had a bunch of his PhD students filling out kind of hand-doing cards to kind of take that profitability research back to the 40s. And that's what we kind of get, that's the kind of stuff we get excited about, because guess what? We found the same thing in the rearview mirror, which makes us even more confident in that being a reliable source of value added into the future.
Making a motion out of investing.
We're certainly not trying to outguess things.
So just a catch-all question, what's one thing that would distinguish you from others?
Well, certainly, I think what we hit on right there, our belief kind of in market prices, our belief in kind of the markets, and using that belief to take known and observable information and use that to add value and then not lose any value through those very expensive trading costs. So that was like 4 things, and you asked for 1, but sorry.
Thanks. Thanks for keeping us on time.
Yeah, absolutely.
Thank you.
Great for inviting us
Thank
up here, and look forward to seeing a handful of you, I think, in Napa next week. Very good.
Travel back and what importantly, you know, your phones for that you're looking at, they will have all these.
Here they are.
They are here. Mr. Chairman, do you want to take a brief break or do you want to just keep rolling?
5-minute break.
5-minute break.
Take advantage of that.
So you want to introduce the?
Yeah, well, thanks for coming in, guys. We're running a little behind schedule, and the board has other matters to take care of later this afternoon, so we're going to ask you to keep your comments to about 30 minutes. And with that, the floor is yours.
Thank you, Greg. And we understand that the clock is ticking, so we'll just get right down to business, but we of course want to say thank you for allowing us to meet with you. And we hope you use the time wisely and help make an informed decision about telling you what we do. Very quick, by way of introduction, my name is Jack Cohen. I'm a Client Service Director at Investec Asset Management. I live and work right down the road in Marin County. So if you're fortunate enough to be working with you, I would be your local point of contact. And my friend and colleague who came from much greater distance is Archie Hart. Archie is the, is the head of our emerging markets equity team. He joined Investec in 2006, and the express purpose of his hire, and his interest in coming to us, was to develop the strategy we're going to talk about today. So he's the architect of it. There is nobody at Investec better suited to tell you what we do and how we do it. And he is the final say on all buy and sell decisions. As I mentioned, he's based in our London office. So thank you much for having us. And in 30 minutes, we'll try to leave a little cushion at the end for questions, but by all means, please feel welcome to ask questions as we go. In terms of allotting the time, I'll do a very quick introduction to the organization. We covered some of it last week on the phone, but if you have any questions, please feel free to get. We'll spend the bulk of the time on our investment approach. If that sounds reasonable, we'll jump in and keep the trains running on time. So let's go to page 6. And by the way, don't be alarmed by the 50-page book. We'll probably use 5 or 6 pages, but they come in handy in Q&A. So on page 6, this is the sort of an X-ray of our organization, sort of the key characteristics that we think any prospective client should know and our clients would say about us. And there are 3 things that we would like to point out to you. One is our experience in emerging markets. The second is we have a number of mechanisms, which are the purpose of which is to align our interest with yours, which is always a good thing. And thirdly, I'll talk a bit about resources, both on the investment side of the house as well as the servicing side of the house. And I'll refer to both the depth of it and, very important, the continuity and the stability of the individuals in those roles. So with respect to experience, to back up a bit, as we understand it, your objective in this process is to address a structural underweight in emerging market equities. If you understand that correctly. Emerging markets are, and the purpose of doing that is not only obviously to increase return, but to diversify your risks. Emerging markets, as we talk about, are a pretty wild beast. It can be a bumpy ride. And the risks inherent in these markets are a little bit different than developed markets. You have geopolitical risks and all these other things. So 26 years of experience has given us a good understanding of what those risks are, but also having been founded and still co-headquartered in an emerging market gives you just a different view of the world. And that first-hand, real-time experience leaves an impression, and it permeates the way we think, particularly about risk and how to manage it on a day-to-day basis. And not to steal the headline, but you're going to hear a lot about diversification, just like you're trying to do at your level. We think very carefully about diversification at the portfolio level as well. Archie will talk a good bit about that. In terms of alignment, it's always good when 2 parties have common goals and objectives. Things just work better. So we put in place a number of things financially and culturally to try to make that happen. And there are 3 that we should discuss very quickly. The first is equity ownership in the firm. The second is our incentives, and as individuals are performance-based. And third is a deferred compensation scheme. So equity, there's no substitute for owning part of the business. It just changes the way you think. You have an intellectual as well as a personal investment in the business. And we like it to be very widespread. So it's not just one or two individuals. The number is 41 today who share ownership in the business, and that number will grow over time. And that's a good thing. In terms of the financial incentives, the way that our clients measure us is by performance. That's our widget. That's what we do. And they generally weigh us a little bit of the 1 year, but more towards the 3 years, so there's not such a short-term focus. That's the way we do it as well. So Archie and all the investment people, their bonuses are predicated on delivering the types of returns that you would expect of us. When we get these bonuses, this is the deferred compensation component of it, a good bit of it, up to 50% for senior people like Archie, is put into a deferred compensation plan and reinvested right back into the funds we're talking about. So the sum of these things, what we're trying really to do in layman's terms is put as much skin in the game as we can so that our thinking, our interest in getting this is the same as yours. If we get that right, that's a pretty good thing. Stability, just very quickly, the firm was founded in '91. I hate the term C-suite, but our CEO, Henry DeToit, the Chief Investment Officer, Chief Operating Officer, were all day one founders of the business who were joined within the first year or two. Just coincidentally, our Chief Investment Officer, Mimi Farini, had his 25th anniversary in the firm yesterday. So there's a lot of stability at the head level, and that permeates down to the investment teams as well. I mentioned Archie's been the head of the team since inception. Very quickly on, I'm not going to touch on equities and fixed income much, other than to say these are important parts of our business. They are working in the same markets as we do on the equity side, many times looking at the same companies. So there's a lot of information that we can glean from their insights as well, which helps us on the, both formally and informally on the equity side. Lastly, the last bullet, we make a significant effort in prioritization and pride, frankly, in the client service effort. We have 25 people in North America for our clients. We're using 11 million. That's a pretty robust ratio. But the point there is that we take it seriously. We understand that the communication and transparency and access and all these things, this is as much part of what we do as delivering the investment results. We're fiduciaries who report to people. We need to keep giving that information to help you make evaluations of us along the way as well. So with that, I'll segue to page 7, just very briefly introduce you to the team that if we are fortunate enough to work with you, these are people you'll get to know on a first name basis. You'll see their names and emails in there as well. So it's split into 3 groups, the portfolio management team, Archie and Adam, both based in London. Archie's the lead, Adam is his backup. Client service, I would be your local point of contact. Doug is the head of our client team, he's based in New York. And on the operations side, Monica and Catherine are just terrific. And any questions you would have about the operational aspects, they will have it right there and they will know your first name. So I'm going to stop there. That was a pretty quick run through. I'm happy to answer any questions that you have, and after which I'll turn over to Archie. But let me stop there and see if I can answer any questions for you. Thank you.
Maybe if we shoot to page 11, and I want to thank Callan for this. So Callan do a very good product, which is the periodic table of investment returns. They do it annually. They rank asset classes by returns every year. They've done this for many, many years. And if you look at the red circles, that's how emerging market equities have done during that time period. Now, when people present emerging market equities, the tendency is to present the top part of that chart, isn't it? Say, this is the great times, this is the opportunity, this is the returns, this is the rewards. You can, when emerging market equities are good, you can make 1,000, 2,000 basis points higher returns than in other asset classes. My problem with that, my problem with that is I've been doing this for close on 30 years. So I've been around at the bottom of this graph, and I've seen returns sometimes be 1,000 to 2,000 basis points lower than other asset classes. So this is a real sort of feast or famine sort of asset class. But just give you sort of some of my experiences when I've been in the asset class. My first visit to China was in 1989, and we arrived at the border, and suddenly we were surrounded by soldiers with guns. And they literally pat you down and take every single piece of paper you have.
Wow.
Every notebook, every book, every magazine, just every shred of paper. The reason for that was this was just after Tiananmen Square had happened. There'd been a massacre, and they were concerned you were smuggling in information to tell them what happened. So very nervous first time I went to China.
I was in Hong Kong during the Asian financial crisis.
Oh, boy, what a place to be.
Well, it was quite exciting at times. So when you say crisis, let me define crisis. So the Thailand equity market, the Indonesian equity market were down 90%, 90% in US dollar terms. Those markets sort of almost ceased to exist. I saw great companies go bust because the great companies just had a lot of US dollar debt. Their currency collapsed, they couldn't pay it back. Nothing they could do. I was down in Indonesia sort of at one point in the height of the crisis. The currency was falling 10% a day. You could literally see shops were just selling out and shutting down because they couldn't afford to restock. No one had any money to buy anyway. And you could see this sort of economy just disappearing down a rabbit hole as you looked. Within 6 months of burning cars and main road to the airport, people sort of trying to escape, the sort of race riots. This can get really scary at times. So I think about this asset class in quite a different way. I don't focus on the returns. The returns will come over time. I focus on the downside. I focus on the risk. I think about when this stuff happens, and we know it will happen at some point, how do we manage that? And this can be quite unpredictable. So I'll give you an example. I came into the office about 6 months ago, and my colleague says, God, have you seen the news? What's going on? Turkey, there were tanks on the streets, there were street battles, fighter jets bombing the parliament, there was an attempted coup. Coup failed, but 250 people died during that time. If I'd had a lot of money in Turkey at that time, I would have been pretty concerned. But I've been around a long time. We have small exposure to some of the more exciting markets, if you like. So when I think about this asset class, it's unpredictable, it's volatile, things move around. We run very diversified, broad portfolios. And we do that because we want to manage the risk. For us, this is a marathon. We're not going to finish every 100 meters first, but we want to finish the race when it comes. And we think about this asset class on a sort of multi-year period, if you like. So what I think we do a little differently is we think about the risks front and center before perhaps we think about some of the returns. So if you look at page 12, this is sort of portfolios that we run and that you've been invested in. So a large number of names, perhaps 70 to 90 names, broadly spread across different countries, broadly spread across different sectors. A structure in how we think about risk. We review stocks we buy in a larger group to make sure we haven't missed anything. We have our risk teams pull our portfolios apart every month and tell us where they think we could do better, where the risks are that we run. We have regular reviews of different sectors, we have regular reviews of our process, just to make sure there's nothing we've forgotten, there's no sort of hole in the argument, etc. And we think that broad spread of a portfolio, that broad spread of risk is really important. If you put all your eggs in one basket in this asset class, you can end up with a pretty bad omelette. If you have a whole number of different baskets, we know that one or two of those eggs are going to get broken, but in general, we'll come through those bad times. So that's the first part of really what we do. Second part is, how do we pick stocks? What are we looking for in a stock? What are we hoping to achieve? And that's where we come to page 13. We have a really clear view of what type of stock we think is good to own longer term. And that has 4 characteristics or 4 factors, and that's why we call it the 4-factor group. So we're looking for stocks which are good quality companies. They're run by basically people we trust, who work hard for us as shareholders, who generate good cash flow, and then use that cash flow wisely. Either they invest back in growing the business, or maybe they give it back to us in terms of dividends. We're obviously looking for good value companies. So companies where the value is here, we think, and we can buy here, and we think that should protect us longer term. We're also looking for companies where there's some sort of positive surprise, something to excite investors. And we look at that as earnings beating. So if you have a company where the market expects profits to be 100 million, and they make 110 million, 120 million, that's a pretty exciting stock that investors say, wow, this stock is surprising positively. There's a lot going on there, let's get involved. And lastly, we look at trends as well. So when you get, in our business, we get a positive trend, that can persist for quite a long time. So if you look on page 11, you can see 2003 to 2007, the markets are pretty good. You see that similarly in companies. Companies which don't do well tend to do well for quite a while. We want to be in those companies. Now, how difficult can it be to find a company that's good quality, it's cheap, it's seeing this positive surprise, it's seeing this positive trend? The answer is actually it's quite difficult. And the reason it's quite difficult is that every day of the week you get information systems, Reuters, Bloomberg, newspapers, TV, magazines, hundreds of brokers calling with thousands of ideas. It's actually very tough to identify these ideas sometimes because there's so much noise. What do I focus on? We have a filter where we filter out 3/4 of companies that we think are not relevant. Maybe they're poor quality, or maybe the earnings are going down, or there's some issue. So we just focus our analyst team on the top quarter of names which we think are good investments for your fund. And that is what the analysts do. So immediately they ignore 75% of the stuff that many other people are focused on, just focus on that 25% of good ideas. And this gets us neatly, I think, to, so page 14 is the type of companies we're looking for. Page 15 is our team. So firstly, you can see it's quite a large team. The people in blue, you can see, are the people who work directly with me on Asia and emerging markets. You can see Chinese names, Indian names. They're people who come from these markets. They understand them, they're culturally aware. They go home and visit their families living in these markets. We think that's quite important. The guys in white are the global guys. So we think, if you're looking at technology companies in Asia, they supply Apple. You need somebody who really knows what's happening at Apple. You need that backup. And I can turn to the analyst sitting behind me and say, what's happening at Apple today? What are the orders? What are the earnings? What's happening here? And that's a good lead indicator to me for the sales my company will be making in Asia. That depth of knowledge on what's happening, particularly in the markets, but globally, that teamwork, fundamentally important. This is a team that spent an average of 16 years in the business. Many of these people have worked with me since I've arrived. I've been here sort of getting on for 10 years now, and I'm a relatively new joiner in our business, which is quite scary, I think. It's sort of the baby of the team, believe it or not. And so to get to page 16, we can see a rough idea of where we go. So first stage in our process is strip out the 3/4 of the companies which we don't think are interesting because they're not cheap enough, they're not high quality enough. Then the analysts dig down and find the very best ideas. I put that together in a portfolio where I spread the risk over many different countries and sectors. We think that's necessary when you get the sort of volatility I've talked about. And then lastly, we have independent risk people that look over my shoulder and make sure I'm doing the right thing, that I haven't forgotten anything, that I haven't missed anything. Really important, I think. And then lastly, what does this mean maybe? Let's get back to page 19. And if you look at the bottom chart, so quite difficult I think to visualize, but the biggest bar on the bottom of that chart, page 19, is stocks. We want the return from what we invest in to come from the individual companies we buy. We want the risk to not be that Brazil is good or oil is down or something like that. We want it to be the individual. So if we run our risk right, it's about the individual companies we own. We know some will go wrong, we don't know which ones, but enough of them go right. That's how we do well. We don't want to put 30% of the portfolio in Taiwan when there's a revolution and we're in real trouble. We want to make sure it's about the individual stocks. And the last thing that's very important is the top of the page. page 19, which is around the risk we run. And so, if you're an investor that bought very high quality stocks, they do very, very well in bad markets. Because obviously markets are bad, there's economy, there's lots of pressures, those quality companies do very, very well in that period of time. But then when markets recover, they can do much less well. The guy's still doing the same thing, he's working just as hard, he's just as smart. But the markets sometimes go with him, sometimes go without him. We had that blend of things, so we have value in our portfolios, and we have quality in our portfolios, and we have that surprise in our portfolios. And that's around making sure that wherever we are, whether there's headwinds or tailwinds to different styles, because we're a mix of styles, we hope that something will generally be working for us.
So make sure we finish your thought there. You're certainly implying something about quality doing well in down markets. What have emerging markets been doing, and what are you trying to get us to take away from that?
Okay. I think maybe a good place to go would be page 22. So if you look at emerging markets, they were pretty weak in 2011, 12, 13, 14, 15. Very weak. Economies were in recession, there were currency devaluations, commodity prices were falling, there was political problems. Quality did very, very well in those periods. And you can see we sort of protected the portfolio as much as we could. We did a bit better than the market most of those times. 2016, the market turned around. We did quite badly. It's the worst year we've had so far. The reason we did that was we were defensive. We were trying to protect our investors. Things picked up. We left a little bit on the table. But that's because I'm not trying to win every 365-day race. I'm here for 5, 10, 15, 20 years. I want to win. I want to run the marathon. And that's sort of where we are in trying to do that. And those diversified portfolios, I think we talked about that broad number of 70, 80 stocks, is around making sure that things go wrong, we're a little bit protected from the downside. If things go right, we can hopefully get a little of that upside for you as well.
Greg, I think another point that we would suggest on the top right-hand chart on page 19, which lists in different colors value, strategy, and strategy is a synonym for quality, earnings, technicals, and other. You can see that the bars are lower on quality, and we are underweight. And while the emerging markets have not done well, within the emerging markets, quality has done the most well with these. And you might ask why we are under, and that's because the valuations on these have got quite excessive, particularly relative to the other factors or styles in that, which I think one of our points is that not being wedded to any one style is not the deal breaker in terms of whether we will do well or not, relative or absolute. We try to have a blend of these, and at the moment, quality is looking the least attractive to us.
Question. So tell me about China and Vietnam.
Okay, Vietnam, very quickly, is not an emerging market, as Paul said. We think it might become an emerging market in the next few years, but not now, so we have no investment in Vietnam. China is the biggest single market we invest in, so it's a very important market for me. I lived for 12 years in Hong Kong. I see many people on our team are Chinese. It's a very important part of our lives. To give you an idea about China, America manufactures 12 million cars a year. China manufactures 24 million cars a year. It's huge. It's way bigger than I think people realize because it's so insulated and we don't hear much about it. But it's an amazing place. So there's a town on the border with Hong Kong called Shenzhen. It had 200,000 people in 1980. It's now got 16 million people. So in 40 years it's gone from nothing. It's got subways and airports and centre of technology companies. It's incredible to see that growth. So when you look at China, everyone says at any point in time, China looks bad. It's a communist government, there's all these problems with it. So in 1989, you had the massacre in Tiananmen Square, a terrible thing. People thought there'd be civil war, revolution. In 1995, they shut many state-owned companies were doing very badly, threw tens of millions of people out of work. We thought there'd be revolution, social unrest. In 2000, the banks had bad debts of 40% plus. They survived. So whenever anyone looks at China, they'll tell you things are bad, there are many problems. But over 30, 40 years, they found a way through. And the secret is China's run by 7 guys. I'm afraid it's just 7 guys. It takes them a while to make a decision. When they make the decision, it gets done.
Yeah.
So they work out the problems, they think around them, they deal with them, they think of a solution to do that. You compare that to American politics, where it's tough to get stuff done, isn't it? Even if you're Republican president, Republican Congress, Republican Senate, it's still tough to get things done. So I would say that there are many, many risks about China, but we believe that they continue to solve them. And so China's a very risky place, but overall we think that longer term it's a very good job. They've pulled hundreds of millions of people out of poverty. So this is a place. I first went to Shanghai in 1989, and I was in one of the first hotels in Shanghai. 20th floor, you looked out over the city at 8 o'clock at night. It was dark. You could see 1 or 2 lights in the distance. You walked out on the streets, there were bicycles everywhere. No cars, just lots of bicycles in the old past. Go to Shanghai today, it's like any city you'd want. No bicycles anymore, everyone's in cars, so that the progress has changed.
Except you still can't see 3 buildings down because of the air pollution.
Well, again, one of the good things about that is they're finally doing something about that, which is good. So, for instance, they're the biggest manufacturer of solar panels in the world now. More solar panels made in China than anywhere else. So they're beginning to deal with that. They have a long way to go, but they're beginning to deal with that. And the reason for that is, in 1989 when I went there, it was about finding food. It was about finding work. It was about those things. Now the Chinese have a very nice flat, a new car. They look around and say, that river's black and I can hardly breathe. I've got a nice flat and a nice car, let's deal with the pollution. And the government gets that message and doing that.
Can I ask, are you doing any work with CalPERS or CalSTRS?
We work with CalPERS on an emerging market strategy on the debt side.
Okay.
But I have no money with them.
Correct. Though CalSTRS, we are not working with them. Their last emerging market equity RFP was in 2013. The way they do it is kind of odd. They select 6 managers, they fund 4, and 2 sit in the bullpen in case we're one of the 2 in the bullpen for CalSTRS, but we are not managing any money for them.
What other 37 Act?
No other 37 activities in this strategy.
We have, is it $1 billion with US clients?
Yes, about $4 billion total, which is actually a pretty small number in terms of managing the capacity. 25% of that, or about $1 billion, is with North American clients.
Am I reading this correct on page 12 where it says typical number of holdings?
Right.
70 to 90s?
Yeah. It's about 80 now. And the reason for that is that I and everybody else would have told you Turkey was a fine place 6 months ago, and then one day there's a sort of a revolution there, a temporary revolution. If I'd had several stocks in Turkey, in a small portfolio that would have been pretty bad. I had 2 stocks in Turkey in a portfolio of 80. Those stocks got hit, but the overall portfolio, that was just a small down, and that's why we run that wide variety of companies.
So in the back of the book, it says it's approximately 1,000 stocks that you look at.
So we find the best data.
That was a very good pickup on the number of stocks. One of the things we would shame on us if you don't take it away. That is a very decided, active risk component of what we do. Decision to run that many stocks, which is, by the way, not diluted. It's still very much active. But that also allows us, between the number of holdings that we have, and keeping assets low, it allows us not to just focus on larger capitalization stocks, which are highly liquid, but also when appropriate, to be more middle capitalization, some smaller capitalization names, both for return and risk purposes, but also to provide you with the type of exposure, which is really the purpose of what you're doing at the end of the day.
I'll give you an example. It's quite stuff at work we're excited at the moment. At the moment, we own a Chinese car company called Geely. It only sells cars in China, so you won't have heard it. And this is a company that 10 years ago made incredibly cheap cars. They made cars they sold for $3,000 or $4,000. Because Chinese couldn't afford anything more. The cars were junk. It made them of steel, which wasn't galvanized. So you buy this car, drive it around the block for 6 months, and it would rust away. This was just rubbish. But this company bought Volvo, right? 5 or 6 years ago. This is a company now, Chinese are saying, wow, this is really well engineered. This is really good technology. This is really exciting. So this is a company seeing sales up 50% last year. They sold 50% more cars, and they got a 20% higher price because people realize, actually, this is a really good product now. I really like this, and it's still cheaper than a sort of BMW or Volkswagen or whatever. That's a $4 or $5 billion company. So I think if we ran 15, 20, 100 billion in the asset class, we wouldn't be able to find these companies to invest in because we limit how much we can invest. We can find these really exciting ideas that many people haven't sort of seen.
You know, Archie and Jack, we're going to have to wrap up pretty quick. Oh, yeah.
On 21, you have your portfolio weights pie chart there. You got 24% or 28, how you look at a financials. How's that stack up against the other folks we might be looking at today?
So I think one of the interesting things about the asset class is the biggest sector is actually technology. So people think about these markets as being sort of underdeveloped, but about a quarter of our world is technology. We have the world's best semiconductor companies. The only place where Amazon, Google, Facebook can't do business is China. So China has these amazing internet companies which just have a monopoly on China. And another quarter is around financials. So most people you meet have very big holdings in financials. Financials, though, is quite a domestic thing. So a Brazilian bank is connected to what happens in Brazil. Eastern European banks, what happens in Eastern Europe, so they tend to move quite differently. So though we have a lot of money there, we think there's many different cycles and many different things happening.
I think the other two firms you're going to talk to today are Underweight Financials in China, meaningfully. And they're a little different in their positioning in both regards there.
Okay, great, thank you.
Okay. Fees.
Yes. Fees are on page, well, the fees are 80 basis points flat, or they set 1%, and those are on page, it's the first page of the exhibits.
Page 25.
Thank you, Archie. Page 25. So yeah, 80 basis points, what that means in two things. One is that that's a discount to our full fee, which would be 110 basis points. So in percentage terms, it's about a 27% favorable discount, and in dollar terms, at 12.6 million, it works out to $45,000 annually. It's percentage of the assets. So that doesn't move. The assets move. Is one of the variables.
Any other questions?
Well, we are very appreciative of your time and consideration. We know this is an important decision for you, and this is a very important opportunity for us to. We'd be honored to work with you. We would be familiar faces and voices to you as well. And I wish you luck in your decision, and I hope we did a good job. Hoping to make an informed one. And again, we appreciate your time and look forward to hearing back from you. Thank you very much.
Thank you for making the trip.
Thank you for coming up. And if you're British, you have to come this far to find the sun. So.
Thank you.
Thank you.
I think we'll take a 5-minute break. 5 minutes.
I'm trying to
So I think we sort of introduced, but I'm Meg Reynolds. This is Celeste Tambaro. I am the founder and portfolio manager at Westwood Global, and Celeste is our director of marketing. So thank you all very much for inviting us out here today. And I'd love just to tell you a little bit about why we started Westwood, and my partner Brian Ward sends his regards. He's sorry he couldn't be here. But Brian and I, just to give you the background on who and why, I think because that leads into how we invest. We met at Putnam in the early 90s. We're in the International Equity Group there together. And we went our separate ways and came back together to form Westwood Global because in 2003, because we really believed that emerging markets was being tackled just solely from a macro perspective. And we really felt there was an opportunity to be a bottom-up stock picker in emerging markets, that these companies had, we saw crisis after crisis in emerging markets, and they could manage through the macro situations better than we could try to figure out the macro situation, where the next crisis was going to come from. And so we talked with the companies, we kicked the tires, and we invest in the long term with companies that we have seen stand the test of time and have, be it a crisis or be it something unique, and have not just come out and survived, but have come out bigger and stronger. And that helps us sleep at night. Hopefully that'll help you sleep at night. I mean, when we first decided to start the company with a focused portfolio in emerging markets, people thought we were crazy. Isn't the volatility just going to be too extreme? Why would someone invest in that? And so for a long period of time, we had to calculate the volatility of the portfolio versus the volatility of the index to get people comfortable. And it turns out that you can get diversification from a 30-stock portfolio, and the way we invest resulted in the volatility of our fund being less than the index. And so I'll get into that and let you know. But I think just investing in companies that have withstood the test of time, they therefore have strong balance sheets, primarily always, because they don't, you don't know when the next crisis is coming. They generate free cash flow, and they generate cash flow and they use it well. And if they don't have a use for it, they return it back to shareholders. So it's as simple as it is, and that's what we're looking for. We settled on sort of a concentrated portfolio because we felt as bottom-up stock pickers, your portfolio should reflect that. And we want to know these companies better than anybody else, or as well as we can possibly know them with the information available in the conversations that we have. And we just didn't feel in prior lives we had owned more stocks. But both of us in our prior lives were sort of whittling down our portfolios from, what was a ridiculous number of names, smaller and smaller. And we really feel like we know these companies very well. We want to own them for 3 to 5 years is sort of what we think about when we buy a stock. But we've actually owned companies for 8 years. And so we'll own them as long as they're doing the right thing and they don't get too expensive, we will continue to own them. It's hard to find good management that do the right thing. So we're not going to run out the door just because the stock was up 20%. But in terms of maybe just a little bit, more on the process, Brian and I, on page 4, Brian and I have been doing this a long time, so we know the universe pretty well. But we travel, we kick the tires. Brian and I travel 8 to 12 times a year, and the analysts travel 3 or 4 times a year, and we're meeting with companies that we know well, and we might own, companies we know well and might not own, but they might look interesting, companies we think we'll never own, but you might learn something from them. And then, the suppliers, other vendors, anything where we can just learn about everything and put it all together. And our analysts also are our generalists. They're not sector specialists solely, because we want them out learning different things, and they might bring something interesting. If they cover mostly tech stocks, but they have a consumer name, they might have a different way of looking at it and a different way of asking questions to help us learn something more. And we're always looking. We have 30 stocks in the portfolio. And what we end up with through this travel and through just really thinking about how is this company earning money and is it one we want to pursue, we end up with 30 stocks in the portfolio and about 80 stocks on the watch list. And just to give an example, if I'm looking at a retail stock and it looks, normally valued, quote unquote, on sort of the basic metrics, I have to dig deeper and say, but what's the cash flow that this company generates per square foot? And what have they done over time? So is there a unique opportunity here just because the economy's weak, or they're changing what they're doing and really sort of getting more productive? And through looking that just continuing to peel back the onion for each company, you really can find some great opportunities and companies that are doing something uniquely different that is sustainable. So that's pretty much what we do.
And our home base is Boston, so the portfolio managers and the research team are based in Boston, but the travel and the kicking of tires is sort of a complement to that, going out, gathering information, gaining perspective, and coming back to Boston and having that iterative dialogue of what did we see, what are we thinking, what ideas look good, what do we have in the portfolio, but it's a way of kind of coming back, taking a step back and really looking at the big picture of what we're doing.
And people often say, how do you do emerging markets from Boston? And the reality is, we do the travel, but I think being in Boston helps us differentiate the news from the noise, because not every piece of news affects the value of a business. And I've never, in my prior life at Fidelity and in Putnam, it was always the case that the Indonesian analysts like the Indonesian stocks, the Russian analysts like the Russian stocks, and you can't help yourself but get wrapped up in the emotion of every day. And most of that's non-investable. And so we feel like by coming back to Boston, by being, by talking about everything, we certainly pay attention to the news and the noise of the world, but we really try to focus on what's affecting the value of the business in the long term. One example is Samsung's recent fiasco with the Galaxy, the Note, right? Lots of noise, everybody got on and said, if you have a Samsung Note, you got to turn it off, throw it away, whatever, we don't want it on the plane, and for good reason. And they had a couple missteps in the beginning of sort of how to deal with it, because I think they were really surprised and weren't sure what was going on. But then they figured it out, and they said, all right, we made a mistake. If you bring us your note, we'll give you credit towards another phone. And so from a market share perspective, they didn't lose market share. They revamped quickly because they caught it. And those are the kind of companies we want to work with, because everyone's going to make a mistake. I make a lot every day. So that's really the type of company that we're looking to invest with. The hiccups are hiccups. They're not big blow-ups because they contain them quickly.
How do you move with 25 to 31 companies? How do you move companies in and out? And how often does that happen?
Well, with an 8-year holding period, the turnover in the portfolio is very low.
So it's just, you have a pretty standard, okay, we're going to play this out, then decide.
Well, we have, our shortest holding period's probably been 8 months, because we bought a company and then the CEO sort of fell in love with all the cash he was generating, didn't want to give it back to shareholders and wanted to do something else with it. So every stock in the portfolio roughly starts at a 3.5% position. And then we just let them do their thing. We will, if they get over 10% of the portfolio, we'll trim them back. Other than that, we let them go. And generally we're selling when a stock's roughly 6 to 8% of the portfolio. The nice thing about that is, you're buying a new position at 3% in the next new idea that comes in. So you've got 3 to 5% that you can allocate across the portfolio on underperforming names or names, that have some interest that haven't done all that you think they can do. And that really has worked for us. We don't trim an ad. Every day we're not coming in and saying, oh, that's up 20%, we should trim it, because we believe in the value, the long-term value of the business. If we felt like we should trim the stock, we would sell it, except for that 10% when it's doing really well. If it's still cheap, we'll keep owning it. And you brought up on page 5, you can see, the most important thing is really, from my perspective, knowing when to sell a stock. Made the mistakes too many times of falling in love with the company and then also not wanting to sell the stock. And so you have to be true. And so for us to be true to that discipline, for every time we buy a stock, we have a target valuation at which we will sell it. So that could be a PE multiple or a price to book multiple, whatever we feel values the business properly. When it reaches that, we can't then say, oh, but the ROE is higher than I thought it was going to be. The returns have been better, so it's really worth, 2 multiple points more. We must sell the stock. We don't let ourselves get away with that. We don't let the analysts get away with that. We sell the stock. What that has meant once or twice is we've left some money on the table, but generally speaking, whatever's happening is cyclical and not structural. And so it's really important to sell and walk away. And with the 30-stock portfolio, there's always another great idea on the watch list that is going to have a lot of upside too, so the opportunity cost isn't significant. We will, the benefit of our watch list, we have stocks that we look at every day and say, are the valuation of these names better than something that's in the portfolio, and do we have more confidence in their earnings prospects for a company on the watch list than one in the portfolio. So while we don't do much every day in terms of trading, we think about it a lot. So it's nice for us. It's a reaffirmation of the process when there's a really interesting name that's on the watch list that comes into the portfolio. And that's happened several times. I mean, more recently, we had several stocks that since 2003 had been in the watch list. And over the last few years, we've finally been able to buy a couple of them because their valuation has gotten attractive enough. So we feel that patience is rewarded, and we don't want to pay up for anything. There's still stocks on the watch list that we've never owned, and we love them, and they just haven't corrected enough for us to be interested in them. We've been, as I said, with the 8-month, if we lose confidence in management, we will sell immediately. Brian's called me from the middle of the night, from one of his trips, and we've just put in the sell. We won't, stand around if management's doing something, if we thought they were going right and they take a turn left. We do like to have conversations with them to say, is that political posturing? Like right now, there's a bank we own in Korea that has a new CEO, and the banks in Korea have not been able to return capital to shareholders, so they're very overcapitalized. So the CEO says, I'm going to do international acquisitions because that's the only way I can use my capital. Well, that is not something I want to hear. But we're going to have a conversation with him because he's coming into the office in a couple weeks saying, is that political posturing because there's now a new president and you won't want less regulation, not more, or is that something you're really going to do? And if you're really going to do it, I'm not going to tell him that, but I'm not going to continue to own the stock. And so we do like to have the conversations and follow up. And if we're at one thing, we can be too patient because everyone can make one mistake, but we have lots of conversations and try to just determine if what something has happened is really changing the value of the business before we sell. And the last bullet on page 5 is really a nice way of saying we were wrong, and when we finally figure it out, we sell the stock. As bottom-up stock pickers, if you look on page 6, we do feel it's important to put broad parameters around the portfolio. In Brian's history, he worked at a firm that when he joined them had an EFA product, which is mostly Europe-focused, that had 30% of the portfolio in Russia in the beginning of '98, so that didn't work out so well. And so what we say is, we can be zero in a country if there's nothing that we like, and we go, and for sectors too, generally speaking, and we can go to 30%, 10 percentage points over the index weight. So 30% would be the max would be in any one country. After that, market appreciation might let us increase that. But what that's done is just keep us honest. Right now that the tech sector is growing is doing really well. We've had names that we've owned since 2003 that are finally starting to work. We can't buy any more stocks in that sector, but we can enjoy the advantages of the companies that we do own. And that's just an attempt to keep us as bottom-up stock pickers honest with ourselves about what we're good at and what we're not good at. We don't use cash. We're generally fully invested. Cash, for trading could be as high as 5%, but generally it's 1 or 2%. And we do not hedge the portfolio because as bottom-up stock pickers, when you do a hedge, it's all of a sudden currency. It's all of a sudden the biggest position in your portfolio, and we're stock pickers, not currency. Page 7 just shows our turnover over time, and I would say, the last few years or the last 6 years, turnover has been lower than we would have anticipated. And honestly, that's because emerging markets hasn't done a heck of a lot. I mean, we've got single-digit returns for as far as the eye can see, and that's not what we expect of our world. But earnings have continued to grow. So what we see, is we like to have turnover because stocks reach their target valuation, and when that piece is missing, that's a problem. So I don't need to have higher turnover, but I like it when the stocks, when at least 1 or 2 stocks a year reaches their target valuation. But from the ground up, we see a lot of earnings growth from our businesses. We see a lot of efficiency gains that have come through. So I think we have the opportunity that maybe we'll have to sell a couple because they get too expensive. So we really have, we look for any stock we buy, we look to 15 to 20% upside on an annual basis. So there's a lot of pent-up in our portfolio of opportunity in the valuations. Page 8 is our breakdown by country. We don't look at this at all, except based on the broad parameters, it is a totally bottom-up process. You can see we've been underweight China for a long period of time. There was a period of time where we were overweight. It's just not showing up in the chart. It was a short period of time. We see the banks and the property stocks as uninvestable, and they're a big part of the index, and we just won't be there. The banks don't do risk-based lending, and the property stocks are really tools of the government. When the government needs money, they sell property to get cash because they don't have income taxes. They don't have, it's the only way they get money. I was in Hong Kong 2 weeks ago and met with a property company, because even though we don't like them, we still meet with them. And the company was very negative on property prices overall on developments, but yet they were buying a bunch of land. And so, obvious question, why are you buying so much land if you're sort of negative on your sector right now? And, well, we issued a bond and we got money and it was pretty cheap, so we thought we'd buy some land. And I'm like, well, how, why'd you issue it? How is it? And the structure of the bond is a perpetual bond. And if they do a development and they get in cash, they'll pay the bond off, but they don't have to, ever. So, little factoids from China are always interesting.
They play by different rules.
Yes, absolutely. And so, Brian started his career looking at Japan when there was the property bubble. And so he sees a lot of similarities between China and Japan, except China's perhaps controlling it a little bit more with some non-market forces. So we have to be cautious from the perspective of not owning those. But if valuations on other companies in China get cheap enough, we will own them. If there's a great consumer company, if there's, we will own them. We don't say, no, we're just not going to buy anything in China because, set a rate, not a date. I could be wrong for a really long time, and I have been, right?
Well, you just answered my question. I'm sorry about the lifesaver.
Oh, no, no worries at all.
But I'm asking about China, which you just explained, and Vietnam.
Okay. In terms of Vietnam, we have looked at it. It's considered a frontier market, but we do look at it. But the liquidity really isn't there. Brian, it was interesting because there was a conference that Brian goes to every year, and Vietnam was one of the countries that was represented there. And he went 6 years ago, and there were 100 people, 100 investors. And he went, 4 years ago, and there were 0 investors. So, he was one of 2 investors that went to the conference. So we're always looking, and valuations were more attractive then, but it's, the two large caps are not interesting companies, and so we struggle to find names there. So we do see our companies investing in Vietnam, moving some of their production from China or putting any new production in Vietnam. And they say it's a very difficult place to do business. There's no infrastructure, but they are investing there. So it will change, so we keep an eye on it.
And then my follow-up, do you have any dealings with CalPERS and CalSTRS?
We do not. CalPERS used to be a client of ours.
Any other public entities in California that you work with?
In California, I will have to look in the smaller company. In the commingled fund, we may have a couple of cities.
Okay.
I can't remember exactly, but I know we had some on the watch list. I just don't know whether they on the wait list. I don't know whether they came in. Okay. You'll also see we're overweight Brazil. Again, that was the bottom up. We went to Brazil in the middle of 2015. A company that we knew very well, Natura, the cosmetics company, like Avon, had corrected significantly. We were not excited about consumption in Brazil by any chance in the short term, but the franchise value of the business and all that they were doing to do the best they could in a tough environment had us buy the stock. When we sold the stock back in 2007 or 8, we sold it at 30 times earnings, and when we bought it back, we bought it at 13 times earnings. So we felt we were being paid to wait. We actually weren't, because the currency collapsed right after we bought it. And so we've used cash flow from dividends sort of to add to it after that fact. And so, sort of averaged in nicely, although still preferred to wait to buy it. But they're doing a good job. And some of the upside is just from performance in our names, because several of the names obviously underperform with the weak currency. And so where we could, we added to all of the positions in the portfolio based on liquidity. Taiwan and Korea are overweights largely because of technology and how that has done for us. We do own some of the bellwethers that you would know, like Samsung Electronics, and we own a bunch that you wouldn't know, but they have done very well. Tech is finally having a sector, a cycle. We've owned Samsung since 2003, so it's nice to have patience rewarded a little bit, but it's still trading, at a almost double-digit free cash flow yield. So it's hard to beat that, honestly.
So what would you have in Taiwan?
In Taiwan, we have, which ones are listed there? Hanhai, Taiwan Semiconductor, thank you. They're all the tech. And maybe that's it? I think that's it. Yeah, just those two. We did own another company, President Chang, but we had to sell it a couple years ago because it got too expensive. They had the Starbucks franchise in China, as well as in Taiwan, and the 7-Eleven franchise, but it got too expensive. So it's a great business. It went back on our watch list, but we can't own it right now. And they look like they just got another license for 7-Eleven in China, a different part of China, so we'll be wrong on that. Of course, that does happen. On a sector basis, obviously technology we've talked about. Financials are an underweight. We have been overweight financials before, despite the fact that we don't like the Chinese banks. But we sold a bank a few years ago and nothing's just jumping out at us. There are 2 stocks sort of higher up on our watch list that are banks, but generally speaking, valuations are pretty full there. Energy is a tougher sector in our world just because they're mostly state-owned enterprises that aren't run for profits. So we've never been overweight that. Where we are finding opportunities, we had added to materials, the 3 materials names that we own, or commodity names that we owned back in December of 2015, January of 2016, when the cycle was really collapsing. And we did a lot of work. I'm like, am I an idiot? Are these companies all bankrupt, or what is really happening? And we had lots of conversations with the CEOs. We talked to the CEO of BHP, Rio Tinto, Valley, Anglo, and just to understand what was really happening. And we got comfortable with it. Cash flows, operating cash flow was positive. They were all at tail end of sort of capital expenditure cycles for new projects. And when we got comfortable that they were taking this seriously, that they were selling assets, that they were really focusing on deleveraging the balance sheet and could become cash flow positive, even after paying debt and everything, within 18 months, we said we'll add to them and we'll continue to own them. We did that. Fast forward, and they've done well, and so you talk with the CEOs again and say, are you as strict about deleveraging, use of cash flow, and focus on only the best projects? And 2 of them were, and 1 of them wasn't. So you will see sort of that material sector weighting will come down. And where we find interesting ideas is actually in the consumer sector in Asia. We're still debating whether it's a staple or discretionary, because one of the things they make is ice cream. So I think that's up for debate.
No, that's a staple.
I'm allergic to dairy, so Brian agrees with you. But so it's interesting because the consumer names got very expensive when people were sort of, how I describe it, sort of hiding in emerging markets. They liked the story, they wanted to be there, but it just all wasn't making sense. There wasn't growth, and so they would hide in consumer staples. So companies we really liked were trading at 60 times earnings, and they're growing at 3 to 5%. So that made no sense to us. So we just watched and waited, and those companies are now at the top of our watch list. So, and they have great ROEs and really strong businesses. Take advantage.
Couple quick questions.
Yeah,
We
yeah.
only have about 5 minutes left
Okay,
for the group.
please ask, yeah.
So I want to make sure they have an opportunity to ask a question. But can you talk about the size of the company that you typically buy, the market cap? You've thrown out some names, and they're actually companies we recognize. A lot of times in emerging markets, you don't recognize the names. So maybe talk about the cap.
And we do it more from a liquidity perspective. So we buy stocks that trade more than $10 million a day. Obviously, in general, the liquidity is much higher than that. For
Do you have a low
statistics.
turnover? Why do you do that?
Because liquidity still matters.
Yeah, if you want to get out.
Yeah. I mean, you can always get in. It's like, and before we invest in any country, we have to be sure we can get our money out. And why we were only in Argentina through 180R, even though I liked what was going on in the country, is the capital control still existed, right? And, you know, it's still Argentina.
Yeah.
I mean, wonderful people, but the government can only do so much if the people are not supportive of it. But in general, you know, our average market cap is higher than the index. I mean, these are from the marketing, you know, reports that we get, but our median market cap is much lower than the index. So we own some of the names you know, and then we own a lot of other names you might not know. So.
Quality seems like an important screen for you.
Yeah.
Okay, some people might come in here and say quality's overvalued.
Yeah.
What you can.
And I guess it's how you know, everyone probably is, no one's gonna tell you to come in and buy lousy companies, right? So it's sort of, but how we define quality is the ability to generate cash flow and use it well. We don't buy IPOs because we want to see management execute. And we like it when something goes wrong in their sector or the country, and we can see how they execute through that. And so quality from our perspective isn't expensive. I mean, because we're not growth or value, and we can find quality in any sector, right? Some people might say it's always in the consumer space, or, you know, they don't buy materials because they're all stupid, or, you know, I mean, because they do the same thing every cycle and seem to overbuild at the wrong time. We're really looking for quality as defined by, you know, ability to generate and use cash flow well. And if one quality stock gets expensive, there's another one that we find an opportunity with.
Got it.
So I think it's probably this definitional.
Got it. Okay.
Yeah. Any other questions?
How much money do you have invested now in these companies?
Our firm has $9.3 billion in assets, of which about $9 billion is in emerging markets.
Thanks.
And the commingled fund, which is the vehicle, probably is $3 billion.
So you were historically closed.
Yes.
Maybe just share a little bit about that history. Would you be closed again? Would that affect our ability to come in, come out? Why are you open now?
So when we started the firm, we said, you know, we want to have a great business and we want our clients to have great performance. We didn't want to start on day one buying small caps, and then, you know, you get to $3 billion and you can't do that anymore and nobody's happy because the process changes. So since day one, we've had the same process, and we said at $3.5 billion we will close to new assets so that we can grow with our existing client base. But what we also said is we'll match flows. So if there's a redemption, then we have someone on our wage list that matches the flow. What we've also said is if the market corrects 25 or 30%, we will offer the opportunity for our existing clients to add money in and maybe take a few new clients off the wait list. And with the corrections that we've had in the market, that's happened twice for us. And with this last correction, we had the opportunity to bring a lot more new clients in. So technically, we're closed, but we've had you all on the wait list for a long time, sort of as a Callan as an institution. And so we had a redemption come through, and we have been talking for a long time, and it was the exact size of what you were looking for. So, and it's not usually, you know, the flows happen every month. So, you know, we get about 250 million in redemptions a year. People are rebalancing, people change consultants, you know, a lot changes in people's lives. So it hasn't been too much of a constraint for our clients or for new people to come in.
Is the fund both, the total fund both a mutual fund and a commingled?
We are not a mutual fund, we're commingled.
All commingled?
Yeah.
And you run separate accounts too.
And we run, yes,
So
we
that
do run
9 billion
separate accounts.
includes separate accounts, and then.
Right, three of it is the commingled fund, and the rest would be separate accounts.
I didn't see it, but the V?
The V on the commingled fund is 115, which includes custody. We changed our custodian about a year ago, so we were able to reduce that recently, which is nice. So we use Brown Brothers Harriman as a custodian, and KPMG is our auditor. Anything else? All right. Well, thank you all very much. If you have any further follow-up questions, don't hesitate to reach out.
Great, thank you very much.
Thank you. And I hope you can get out of here and enjoy the rest of your day.
Third time.
Please get me.
Yeah, right. Funny thing about gravity. Interesting. Really use that for time.
Yeah.
Yeah.
No, absolutely.
That's one of them. How
How different the three.
Yeah. Well, and you know, really the holding thing, we're gonna be, like, the last two had such a low number of holding, that first one has a crazy number of holding.
I know,
I mean, that's a big, oh, that's a big.
4,400.
I mean, that's like, I mean, that feels like that may be an outlier, but I don't know. I mean, these,
Also, it was the index fund.
Yeah.
Well,
Yeah.
the difference, these guys can get up to 30% of one company in the portfolio. It's like, wow, it's a pretty heavy weight.
Okay, so
Great job on bringing this.
Yeah, you gave us a real,
How different they are.
That's our goal.
restaurant, Chinese restaurant, hamburger.
Diapers.
And hopefully they're all good. All the meals are good.
I love all those foods.
Leah's scared of you guys.
Come on.
It's like I got grades to the adult people.
No behavior.
Should we wait for Craig, or do you want to do a summary?
We should wait for.
yeah,
We'll wait a few minutes. Okay. It's a reasonable accommodation?
yes.
I'm sorry.
Lawyer joke.
Okay.
A lawyer joke, which means it's not funny.
It's a funny term. I'm watching this interesting discussion at UCD, at UC Davis, about graduation and a reasonable accommodation versus a special need for a graduator, which is like, wow, how many different kind of definitions
California.
can you put into that stuff?
We're actually slightly ahead of schedule now.
If I may, while we're waiting here, can you tell us, I don't think any of these three are actively hedging currencies, is that correct?
No, hedge currency. Yeah, that's right. That's right.
I thought I recalled that, but
Yeah.
I just wanted to be clear.
And in fact, Westwood was the only one that brought that up, that mentioned it, but none of the other ones hedge currency as well.
Good.
And was I dreaming, or does one of these, would we be their first investor? No, I was probably dreaming.
This was a new fund was to be created.
That was the International Small Cap one. That's next month.
Okay.
And it's not you're not their first investor, but you're the first one in a fund.
Okay.
Yeah.
That was
So-
one of my questions.
That'll, we'll cross that
I
confusing.
didn't think I read that
discussion.
anywhere in here, but I thought I heard that somewhere.
Yeah.
Just kick it off, I appreciate the progression in the groups, because it looked like the first group was bigger investment pool, investing in the markets based on their market demographics.
Formula.
And then the formula, and then it's honed into smaller and smaller portfolios, and also the fees went up too. So
That's right.
the second group was 50% higher fees,
Yep.
and the third group was 110% higher fees than the first group.
That's right.
But it was a very different strategy.
That's right. And you know why we did it that way? Because that's the alphabetical order.
Exactly correct.
I wish I could, we try not to bias, like, who you pick based on how we order, so we just did alphabetical. But it happens to turn out that way, that it lines up very much where you have the structured manager buying the market and tilting the portfolio with a very low fee, very predictable performance. We know when they're going to do well, when they're not going to do well, right? Based on their few factors they look at: size, value, profitability, and trading by momentum. That's really what's going to drive their portfolio. It's very explainable, right? And hyper-diversified, and then they limit the country exposure to 17% in portfolio construction. So that's the one up front. You might even call it smart beta. A lot of people are throwing that term around, but really that DFA's been doing smart beta forever, and that's really what that is. Then you have Investec, who is kind of somewhere in the middle. They have 80 securities. They have a quantitative screen up front where they screen on their 4 factors they talk about, which include value trends, or which is a form of momentum, positive earnings surprise, which is kind of similar to what DFA is screening on, and quality. So they've got those 4 factors, and then you have a person at the end of the day, as opposed to DFA, which is a little more algorithm. That's probably not the right word, but a little more mechanical. You have a person at the end of the day who picks those 80 stocks for you, and that was Archie, who we met. But they tend to control risk around the benchmark a little bit, right? You see their country weights are pretty close to the countries, their sector weights are pretty close to the sectors. So what you're trying to get is Archie's security selection based on those 4 factors in his human intelligence overlay. And then you have Westwood at the end, who's a very fundamental, bottom-up, I'm going to pick 30 companies I like and I'm going to hold them. And I define risk control by knowing the company and selling it when I don't like what's going on, as opposed to risk control being, what's the index look like, how many names do I have in the portfolio. So their view of risk is very different from the other 2 companies' views and definitions of risk. Now, the way it turns out is that, you know, the fees are proportional to the active risk they're taking. And the performance has been proportional to the active risk they're taking too. Now, all these firms have performed well. If you would have had them, you would have been happy with them. And so the fees kind of make up for on the performance side. And we have a whole bunch of performance exhibits in here. Yeah. What I would challenge you to do is pick the strategy you like, and not so much look at the performance, because performance is going to come and go over time periods. And what's going to make you a successful investor is to hold on to them over the long run because you like their strategy. And then you fire them when the strategy changes, the people changes, the organizational changes, not just when they underperformed over a quarter, something like that. So I guess that's kind of like a quick summary from me.
Could you see that much of a difference in how they go about acquiring their various equities or whatever, with Investec, who was saying that they are focused on risk? You know, the whole risk piece is, I know, something we grapple with all the time, but is there a difference?
I think they all define risk differently. I think it's really definitional how they view risk differently. And you can see it in the way they build their portfolio. So DFA defines risk as taking tilts relative to the market, and you invest in risk factors: size, small, value, momentum, and they tilt the portfolio that way. And they say, I want to take out company risk. That's why they have 4,000 securities. They don't want it to be based on one company. They want to invest risk in a factor. And they say, I don't want to put too much money in one country, so I'm going to cap it at 17. So that's how they view risk. Investec is kind of a combination of the two a little bit, but they view risk also relative to the index. Archie may not use this term, and I'm sure he's going to watch this video, so I apologize, Archie. But if you look at their country weights and their sector weights, they're around the index. That is a component to the way they think and they build the portfolio. So there's a little bit of that thought process, but he's also buying 80 companies. It's, you know, bigger than a brag box, smaller than a house. You know, it's, you know, you're not putting all your eggs in that, but you're not hyper diversified. And then Westwood defines risk by buying a company you don't like and it going bad, right? And so their risk is not knowing the company going bad. So they put a lot of emphasis emphasis on just buying what they call a quality company, someone who generates free cash flows and gives back to the investors. And then that company doesn't go away, right? Now, all three definitions of risk do well in different environments. Westwood could be wrong, and it could be an Enron scenario, right? Investec could be 26% in China where everyone else is halfway and China goes down. DFA could be small cap in value while large cap in growth takes off, right? So they all can be wrong from time to time, and hopefully the risk profile, whatever it is, you're comfortable with, because you got to hold these guys for a long time, right? To be successful, we got to hold them, hopefully at least 5 years, and hopefully longer than that.
Would this be a time to ask James what he thinks?
It's always you can always ask that question. I don't always have a good answer. I think about investing, I bring certain biases, and I have those biases because I believe in them fundamentally. I've talked about with the board that I believe in the efficient markets hypothesis, but not in the international space because there's not as much coverage there. I believe in it a lot more in the domestic large cap space than I do in international markets. And emerging markets are even less efficient than are the international developed markets. So I think of DFA as kind of an enhanced index type strategy, and the fees are corresponding there, but it's not necessarily bad. It is a strategy, smart beta, enhanced indexing, whatever you want to call it. You're going to get something that's going to look like market return, the index returns plus a little bit over time. At the other end of the spectrum, you've got Westwood, and they have the lowest correlation with the index. And they approach it through a very fundamental bottom-up stock picker approach. I like both of those approaches in different environments. I'm a big fan of the bottom-up fundamental stock pickers where there's less information. I believe over time, if you stay true to that, you can outperform the market net of fees. It is going to be a much more wild ride. You just have to know that. And then you've got Investec, which is kind of in the middle of the two, using, like Greg said, the more quant screen. I think the question is how much different from the index in the emerging market space is the board comfortable being? If you really want to go after it, you go with the much more concentrated portfolio. If you aren't comfortable with that level of additional volatility, which is debatable. I mean, Westwood does have a smaller standard deviation than the other managers, but they're not going to look like the index. If you're uncomfortable with that, maybe you go towards the other spectrum. So, I'm not telling you what to do. I'm kind of trying to frame it a lot like what Greg is doing. What are your thoughts? I guess I would. You can't make a bad choice here, I think.
Yeah.
You can throw a dart and you're going to end up with a pretty good company. It's just which process do you believe in the most and do you have the most comfort in?
Would you comment more on Westwood in regard to being a closed system and opening up and why it's opening up the opportunity?
Yeah, so they grew to $9 billion in assets, and I think they probably have some large investors who are redeeming for their own reasons, and not necessarily because emerging markets is overvalued or anything like that, but rather, those large investors need cash, and I think they're opening up because they've got cash going out the door, and they have they want more client assets coming in.
How long were they closed?
years.
I throw in for Westwood.
And I'm leaning toward Investec.
Is there safety in numbers with the company that has 4,000?
Yeah, that's up to you.
Yeah, that struck me as an index
Yeah.
fund.
Yeah.
I mean, you know, if you look at the numbers here, and there is a slight outperformance.
Index
but,
fund with a tipple for a lean, right?
Yeah, that's right. It's
An
Do you
English,
wanna throw
an
one
index fund with a what?
A lean.
A lien. Oh,
A
Do we
lean
wanna-
with value, a lean with small.
Throw one out first.
I was impressed with
Okay.
Westwood as well. I like the style.
I liked Westwood, but I think I'm just too nervous about only holding 25 to 30 companies. This just seems like a lot of risk for us in our position, but I liked all of them. I thought they were
Yeah, these
good.
are
I would favor
three-
number 2.
I-
Westwood.
Investec,
I got
Investec would be who I would favor.
Yeah.
Westwood, I do like them. I do like them. Are we throwing out the big one? Is that?
I like that one. I like
Okay.
the-
I mean, I was just gonna say, sometimes it's easier if you're only talking about two as opposed to.
I got the impression that Westwood was pretty much a large cap.
Yeah, they were sticking.
They mentioned Samsung and
Yeah,
Taiwan
absolutely.
Semi.
Absolutely.
Yeah.
Yeah, large cap and quality.
So, I mean, you know, I think that's maybe one response to your comment is, yeah, granted, it's 30, but it's not, you know, I mean, these are gigantic
Considering,
companies.
considering
Samsung,
its
yeah.
emerging markets, having those big solid companies.
Do you know other pension funds have invested in this field generally?
Oh,
Is it
well,
across the board?
all three of them
Okay.
would be employed by other pensions. And, you know, some pensions have multiple emerging market equity managers. We're not recommending you to do that, given the asset size. But that would also make them think, I want to add a few. You know, that might, you know, if you have a few concentrated managers put together, you feel more comfortable than if it's your only one. But all of these firms, one, Callan thinks they're all great. They're all very different styles, and they're all employed by sophisticated institutional investors.
This might be my shortcoming, that I didn't see it, but looking through the handouts that we got today, I can kind of make an apple-to-apple performance comparison between Dimensional and Westwood, looking at page 28 and 10 respectively. I wasn't able to find a similar breakdown in the Investec handout. The closest I got was page 22.
What about his stuff?
Yeah, that's what I'm probably missing out today.
Yeah, if you want to take a look at here, so that's that lines them all up. And cumulative time periods ended in March.
I think page 6 and 7 to me is like really can lays it out.
Yeah, a good point. That's the risk return chart.
Yeah. Six and 7 in the calendar.
So I have a question for Jerry. Why were you asking about Vietnam?
I actually went to Vietnam and China when I was chair of the CalSTRS board in a global pension forum was what it was, 2.5 weeks. And Vietnam has a lot of very interesting things going for it, including its people, you know, who are hardworking and industrious, and then the government situation negates that. I wanted to see, and I asked the same questions of all three. Wanted to see the response, and you know, to say Vietnam's frontier is absolutely true, and China is. I was more after the China is than I was after the Vietnam. I just wanted to see how they handled it.
And it's the largest country in the index, so you need to know how they view it.
Yeah, absolutely on that.
So is there any concern about the amount of financials in any of these?
Not in this at all.
I thought it was interesting to hear how they all viewed it differently and treated it differently. And I think that tells you a little bit about the way they build their portfolio and the way they view the world. DFA excludes categories of financials, right? They say these aren't stocks, these are REITs, right? Investec was close to, they were really close to sector weight, right? Showing a little bit more of a benchmark awareness. And then Westwood was like, hey, I don't like it, I'm not gonna buy it. Right, so it's all, very different styles. And really, I think that really illustrates, the way they all manage portfolios differently.
Well, if I, just at a quick glance, and then page 1 there in your handout, Greg, I think there's obviously past is not prologue, but the performance figures there by Westwood in particular are pretty impressive over time. We're looking at that 7-year number in particular.
Indeed.
So on what Craig's talking about, on page 28 of Dimensional, which just, I was liking their strategy, but when you look at their 10-year average, then they're above the index, I guess, by about 1.2% or 120 basis points. And, but then Westwood is outpacing it by, I don't know, like, quite a bit more.
Oh, yeah.
Over a 10-year period.
And so both of them net of fees have beaten the benchmark. So the DFA number you're looking at is net of fee. And that's at the 50 basis point or 50 whatever basis point fee. And then Westwood's at the 1.15% fee. Both have beaten it. But yeah, Westwood has outperformed. I mean, it would be about 3.5%, right? Once you take their fee out. So their outperformance is meaningful, but they're taking, it's not all just positive, right? You've got to be able to live with the downside with it too, right?
So just on the question, the point that James brought up about getting value from an investor on small companies, but just as a counter-argument to Westwood, though, is if they've got large companies in their stock, how is it that they're seeing value that other people aren't? That is not being captured by an index, like Samsung.
Yeah, how have they done so well with a low turnover, right? And buying companies, holding them 7 years. They say they buy good quality companies and they just hold them, and they have the management teams that they believe in that are going to return free cash flow to the investor, and they think that's going to work over the long run. There are other investors in the U.S. who have similar concentrated strategies, and it's worked for them.
I would characterize it as, if it's, when you're running 4,000 names, you don't know, you know the names, but you don't know a lot about them. When you're running 30, you are exceedingly intimate with those companies. You're talking with management. You know the name of the CFO, and you have his phone number where you can call his office directly, his or her office directly, and you're talking to people that suppliers and competitors and all that kind of stuff. That's kind of the it's very, very, they really get to know who to.
Well, you can love the stock, company, but not the stock. I mean, their comment there, I think, is a pretty, you think about things you do in your life. Oh, I love doing this, but can I afford it? Is it going to be good for me? Or
of course, it's not proportional, but they have $9 billion in 30 companies. You just divide 30 into $9 billion, that's a lot of money in each single holding. Are they big enough to move the market when they do things?
No.
Because it's a small market, isn't it?
Well,
The emerging market
it's,
is.
I could try to do the math, Tim. About how big that market is, it's 20% of the total, which is trillions of dollars.
Yeah.
but you got to
It's
look.
huge.
You got to look at.
Well, the whole market is
spread.
trillions, but the EM, that $9 billion isn't a huge number for EM. One of the larger EM managers is Aberdeen, and they have multiples and multiples and multiples of that.
So there's 14 countries that are spread through. And then there's 12 sectors, 10 sectors.
The other map I was saying, how much do they have in each holding?
Right. So could they get out of the name if they own too much of it? They don't own too much of Samsung, right? I mean, Samsung's a big company.
So they were like 30% in tech, 20% financials, 18% South Korea, Brazil 18%, Taiwan 16%.
Can I ask a question to James? What did Westwood, when they were talking about fees, including custody?
That's an all-in fee.
So, I mean, is the others not including custody?
No, all of
Oh.
them shown on the calendar report, it's all in.
Okay, because I didn't know why she specifically said including custody and the others didn't say that.
It's just left out of the proposal. I mean, that's,
Well, they're all the, like, I think DFA definitely showed it, and we have that information for
Okay.
InvestTech. So what happens when you invest in a fund? There's someone who creates the fund and holds the assets for the fund. There's a trustee and a custodian. And that fund has to pay that trustee and custodian to do those things. So in the case of Westwood, it's Brown Brothers Harriman, which is a respected bank, and no worries there. That trustee then technically pays the advisor, who's Westwood. So Westwood gets paid 1.1 or something like that, 1.1, and then the trustee gets 5 basis points.
Okay.
And all of these funds have that. Every mutual fund you invest in has that too. So when you look at a mutual fund, you'll see something that says total expense ratio, and then you'll see investment management fee on it. And the management fee is almost always often less than the expense ratio. And that's because there are these other expenses of running a mutual fund that aren't going to the manager, if you will.
If I may, Mr. Chairman. I think the reason it was mentioned is because they went through a custody transition last year, and that's a painful ordeal.
Yeah.
So it's probably a little more top
Okay.
of mind for them.
So,
Are we looking for a motion? I'll make a motion that we go with Westwood.
Is there a second?
step out of the room, would you?
Doesn't sound like I have a second.
I'll second it, just to.
I could go with Westwood or InvestTech. Those are, I mean, clearly, I don't know if is that what everybody's thinking? Is everybody?
Well,
On those?
can we talk about Westwood and people's concerns? Can we have everybody make a statement?
Here's what I'm thinking. We've got really two very, very distinct approaches. Right on the one side, we have Dimensional, which is, to me, is just it's an index fund. If you look at the chart, 1 year it's flying high, and then the next, there's hardly any middle ground. And that, granted, we're arguably at a low point from that performance standpoint. So you could make the case that now is a good time to be buying it, I suppose. But, I'm just kind of nervous of an index that's up 30% 1 year and, down 70 the next. Yeah, I know, obviously that's market risk, I get that, but, as I said before, past is not prologue, but, I'm looking at these performance numbers, and I personally find a little solace, the whole idea of emerging markets gets me a little squeamish. I realize we need to go there from a diversification standpoint, but I like the idea that if we're going to be in there, that we're in the big names. It's, granted, when you're picking stocks, you're not going to pick the winners all the time, but it strikes me that these folks have a demonstrated track record that, yeah, they've got 30 companies, but they're pretty good at managing that portfolio.
Could you go over again, she made a distinction between the 9 billion and the 0.3 billion.
The 3 billion in the fund,
Yeah.
I think she was trying to make a distinction of, so.
I thought one was a commingled and the other you mentioned earlier was had a different name.
They're all separate.
I thought it was just separate accounts. Same portfolio, but just.
So they have, the firm's total about 9 billion, and they have 2 different emerging market strategies. So the one we heard about today represents 7.2 billion of the 9 billion. So they have other products they didn't talk about today, so that's a couple billion. Of that 7 billion, they have large investors, CalPERS, it's not CalPERS, but CalPERS could give them literally $1 billion or 500 million, and they would run a separate account for that. And so
we go into the commingled.
And we would go into the commingled fund. That commingled fund is $3.6 billion in size. So we're one of the many investors in the commingled fund that's a total of $3.6 billion in size.
And they both have the same 30 holdings.
And they all run the portfolio exact same way. It's just that we're better off being in a fund because the fund has lower transaction costs and custody costs that we can get on our own. So we prefer being in the fund.
I've invested.
Yeah, I could go with either one of these. I liked both of their presentations as far as I felt like, especially with their main presenters, it felt like, especially the last one, Meg, to me, she seemed very honest in the fact that she said, "Oh, we made a mistake. We did," she said that more than once about making a mistake, which is for somebody to be able to say that, I think that carries a lot of weight. I like when she said ability to generate and use cash flow well. I like the fact that they start with the same amount in each company, 3 to 3.5%. That's where they start. Of course, that's not where it ends up because of, you're going to have some gaining more than others, and it doesn't sound like they rebalance or anything. But then she did make a comment about selling when it got
Trimming a little bit.
trimming things down when it got too high. So I guess they do rebalance to some extent. So as far as that, I liked it. InvestTech, I like. The one thing that really resonated with me was when Archie said that he focused on the downside risk. That was really, really high on his, he wasn't even looking at return, it was downside risk. And when you see, as Craig just talked about, where you have portfolios that can drop 80% in a year, it's that's pretty scary. And so that resonated with me. The thing for me, 80 is a little more comfortable as far as holdings for me than 30, but I do get that those 30 are very strong holdings, and they're diversified within those 30. But I do kind of like the 80 number. I feel like a little less exposure. You can just diversify a little bit more. I'm kind of in the diversification, so that's where I stand.
And I've said mine, I'm on the InvestTech side at this point for what you just said, more than 30 holdings, and looking at risk, because we don't talk about risk enough, and going into emerging markets entails a lot more risk than we're accustomed to. So anyway, that's how I would vote.
So I could pitch Craig's motion by referring to the Callum reports entirely. And then if you look at the recent period return rates, page 2 and 3 right now, that DFA and Westwood in what looks like 215, the worst year, DFA was down 14.32, Westwood down 15.55, so they only were spread by 120 basis points. But if you go to the good years, Westwood kicks butt. And if you look at the bad years, like if they're managing for risk, DFA is not doing any better, and Westwood hasn't, I mean, again, 120 basis points when in the actual loss was 60% or so. That's not much of a spread between the performances. And you look at 2011, DFA got kicked hard compared to Westwood. 2010, DFA did 24 positive. Westwood 25 was 26. The next year, actually, DFA won for about 5 points. Then you go drop out in 2008. I mean, you look at the fluctuation, and then to me, you continue in the Callan report. This isn't just about style and interview here. This is the Callan report, who sat here and participated in this big argument we had a month ago about how they set this stuff into research. You get to the risk return reports and graphs, and it's very, the deviation is so close, and then the returns are so different. So if you kind of forget the interviews, because anybody can interview good or bad, or have a style that you like, and you look at the reports, maybe I'll take on Ted's role here for a minute. Anyway, I think it's a good opportunity for $13 million in a place where knowledge about the investments is super, super, super important. And I will say, when I looked at Westwood first, I was a little scared of the numbers. But then again, the president's bank's going to come to our office in Boston, and when Brian goes over there, kind of the total interaction, they got so much invested in each place. They do know the players, and they can look at that person and go, "Are you sick?" Talking to the CEO of the company or something. I mean, anyway. But that's a personal thing. But I think Callum's report is a really remarkable recommendation.
Is that your recommendation?
No.
Well, Richard said it.
So, don't interpret this as a recommendation, but it's all accurate.
That's right.
And all the data is there.
It's evidence.
It's evidence. So what I would counsel you to do is think about the strategy that you like, because we're going to have to live with it. So I'm going to come back in a year, and I'm going to explain to you whether or not this manager did well. So when I come back and talk to you about DFA, I'm going to say value outperformed or underperformed. This is how they did, and they beat the index by 50 basis points. Investec, I'm going to come back and just say, well, they were a little overweight China, a little underweight industrials, and they had this one company, and they outperformed or underperformed by 1.5%. And with Westwood, I'm going to come back and say, you know what, they held this bank in Argentina that either added 3% or detracted 3%. So that's what we're going to hear going forward. And you're going to have to react, okay, what am I going to be comfortable with hearing, Greg? And what's the right risk for me to take on? This is pretty clear risk-reward trade-off. Do you want someone who's going to go out there, make me money? Do you want someone who's going to give me the index return with some tilts in it? So that's kind of where we're framed at here.
So what is your recommendation?
On your chart here.
He's turning red.
On your
Truth
chart
serum.
here,
If you were us,
you want to go back to 2013, is that just this fund?
That's just this fund. That's why we have that supplemental. It says supplemental. That's their strategy going back. I don't know if all the board members have expressed their view yet.
Okay. One, I could be happy with any of these. I have the same concerns Craig really brought up about DFA being too much like an index fund. I would like to try to track the emerging markets, but that's just too much like it. Investec, to me, seemed to hit the middle ground. It's still tracking emerging markets, but it's diversified enough, 80 to 90 holdings, where if a couple of companies go belly up, I'm not too concerned. Westwood, I mean, I could be happy with them. It just seems like they're almost their own thing. like outside of emerging markets. They're picking companies from bottom up, and I think it sounds like they're doing great, but it's just not enough holdings for me to feel safe. And it just seems like they're doing their own thing and they happen to be picking in the emerging market category. I don't know, but again, I can be happy with any of them, but I'd go with Investec.
I'm nervous about 30 holdings myself. So even though I seconded it, I don't know that it's
Yeah, but we need the discussion, and we couldn't if you hadn't.
Okay, Greg wants to hear your two, and then he's gonna give us, him and Lee are gonna give us their opinion.
I think I would go with Westwood.
Like I said, DFA, I would pick DFA.
The first one?
Yeah.
Okay, the big one, okay. Okay, have you heard enough?
Well, I think we need to vote on a
We're
motion.
gonna need.
And what about our illustrious retirement administrator?
Truth serum?
Truth serum.
Inject me with truth serum and force me to pick one?
DFA.
I would pick Westwood.
Oh.
I like bottom-up fundamental stock pickers. That's a bias that I have. I admit that
Yeah.
that's a bias. I've seen it work very, very well over
One that I
time,
share as well.
but it is a bias that I bring to this. I fully acknowledge that. So, but I certainly hear the concentration concerns. Those are very, very real, and I don't diminish those at all. So,
Okay, yeah, it's up to you guys.
I don't think your chair spoke.
Yeah, he said
Oh,
Westwood.
you said Westwood, okay. To me, it's hard. We like all three of these firms, and I want to make sure you have the one you're comfortable with from a risk perspective. I would probably lean towards DFA or Investec because of the 30 stock and knowing how, remember Janus overseas? It's kind of similar situation where, you pick a few bad stocks and can we hold them forever? So that's where I lean to one of the more diversified ones, just from that experience. But it's pretty hard to argue with Westwood's performance and having the two senior PMs being very seasoned. So I guess that's my bias. What I don't want you to do is to over rely on what I just said, because you guys own this decision. It's not me, right? And we're, so that's my leaning.
And Alina?
I like Investec, and my second favorite is actually Westwood. For all the reasons that were said.
So we're indexing on our other portfolio greatly, or at least simplify and lean toward that in some areas. This might be the spot where we stretch, so to speak.
Well, we have a motion.
I think I would be comfortable with either one of those. It's just Investec to me is a little bit higher because of the diversification. But it's the group.
Well, we should vote on this
We
motion.
should vote on the motion and
What
see.
if it fails, then we'll have a
We'll
second
go on.
motion.
Yeah.
But I don't, okay.
Vote your conscience.
Okay, I'll vote with my first choice, I guess.
I guess we have a motion, like roll call, I think.
Ms. Shatmeyer?
No.
Mr. Sullivan?
No.
Ms. Cavanaugh?
No.
Mr. Walker?
Yes.
Mr. Knudsen?
No.
Ms. Harris?
No.
And Chair Jordan?
He wants me out of here.
Okay, do we have?
Oh, that's right, you can't vote. I forgot you can't vote.
I feel so impotent over here.
Wouldn't have made a difference.
Do we have any motion?
I move we choose Investec.
All second.
Okay. Roll call.
Ms. Shatmeyer?
Yes.
Mr. Sullivan?
Yes.
Ms. Cavanaugh?
Yes.
Mr. Walker?
No.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
And Chair Jordan?
Yes.
Thank you.
Sorry.
And if I may, Mr. Chairman, for the record, I just want you to know that your investment consultant is quite the forecaster.
That's who you picked.
You guessed we were going to vote this way?
That was the prediction made.
The middle course.
Yeah, no, we're balanced
The
approach.
alphabetical middle.
I have one comment to make, and it might make you feel better. I would have picked Westwood, and I have a bad history. I never pick anything that turns out good, so.
A past performance has no bearing on the future.
Okay, let's hustle.
Can we take a quick break?
No.
Or can I?
We have more investment business to cover.
Yeah, we've got a lot to do.
I can do this in 5 minutes if you want.
Okay, go ahead.
Okay, we just have a few quick updates. We have performance and then rebalancing that I'll share with you. The first is about rebalancing. Recall at the previous meetings, we decided to change our domestic equity structure. And we've been working with staff to come up with a rebalancing strategy, which they are going to, assuming you give them direction to, they're going to be implementing in the coming weeks, I think it's fair to say. And to be clear, the decision we made before was to reduce the number of large cap managers, which means you will be redeeming over time from Dodge & Cox, Janus Research, Royce, Morgan Stanley, RS, and the affiliated managers group, microcap fund. So we're going to be redeeming with those and rebalancing into the funds we selected. That was a decision that the group made a couple meetings ago. So I think as a matter of order, we just wanted to make sure that was clear, right, James?
Mr. Chairman, if I may, I would, just for sake of clarity, I think we would appreciate board action to terminate those managers and direction to staff and consultants to effectuate that in the most expedient and efficient manner.
Do we have a motion?
It's a decision that was made last month when we did the domestic equity.
Would you like a motion and a vote?
We'd like a motion and a vote, just so that it's perfectly clear.
Could you read them again?
It's Dodge & Cox Stock Fund, Janus Research Fund, Royce Total Return, Morgan Stanley, RS Investments, and AMG Managers Emerging Opportunity Fund.
I move that we terminate those funds.
I'll second.
Do we need to add in rebalance afterwards for clarity or not?
I think we can have board direction for rebalancing in accordance with the plan already approved by the board.
Okay, roll call.
Ms. Shetmeyer?
Yes.
Mr. Sullivan?
Yes.
Ms. Cavanagh?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
And Chair Drury?
Yes.
I'm going to switch to the performance report now. And in the large calendar book, maybe we'll just flip ahead to page 30, where we look at the overall asset allocation of the plan. And on the left, you'll see that you were just a little bit on overweight domestic equity and international equity, a little underweight fixed income and real estate. This is because of the significant run-up we've had in equity markets, and in particular post-election. So when we're working with Stan and James, we're going to come up with a way to rebalance back towards your target allocation, which is your policy. Overall, you're very close to your overall target allocation, but we're just going to rebalance back towards target. On page 31, you'll note that over the quarter, assets increased just about $30 million. You started with 437 and ended with 468 million. You had about $6 million of contributions come in, And then you had investment gains of about $24 million. So real meaningful, positive investment returns in the first quarter. We cannot extrapolate this going forward. On page 33, we'll note that the total fund was up 5.45% net of fees, outpacing your target of 4.86%. Your active managers did really well for you in the quarter after about a year where they struggled. So they came roaring back, which is very nice to see. Over the last year, we're up about 12.5%, where the index is up about 11.4%. 3 years, we're still a little bit behind, and returns are lower at 5%. But as Tim pointed before, over 5 and 7 years, we are actually close to that 8% return. We don't show it on this page, but if you go out over 10 years, we are at 5.7%. So it's certainly the case that you can pick a time period to make a different argument, right? But over the last 7 years, pretty good returns.
And no excess earnings during that time period to talk about.
Yeah,
I mean, really.
Hopefully we never hear about it again.
Yeah, I mean, but that was the one thing, and I'm not saying it wasn't justified, but at one point they kept saying the excess earnings, you're skimming money off the top, but that's not included in this. I mean, we haven't done that for 5 to 7, this probably even 7 years.
2008, I think, was the last time.
Yeah, so these are clearly good numbers.
Yeah.
Yeah, thank you.
If you look at attribution, I'll point out that most of the outperformance for the quarter came from your international equity, domestic equity, and domestic fixed income managers. All of them tended to outperform. And over the last year, your domestic equity and bond managers did particularly well for you. Regarding updates for managers, we don't have a whole lot to report. I will note that AB, your small cap growth manager, has had some changes in leadership and CEO. And this morning they announced that their parent company might be spinning out, changing the way an already public company is listed within the United States. It's a little complicated. They're owned by someone else who might spin out in the U.S. the U.S. insurer of AXA. So that just came out this morning. We'll try to figure out what that means. But AB has done really well for you performance-wise, but that's one organizational update we'll bring to your attention. A number of the problem managers that we've had in the past, Morgan Stanley, for example, bounced back really well in the quarter, which is nice to get a little rebound before we redeem, which we're going to be doing in the coming weeks. So that's kind of a high-level performance overview.
Greg, on our manager status update report, we're down to one manager left, and that was PEMCO. That's a carryover from the Wells notice.
Yeah.
Would you feel comfortable with us removing them from that status update report?
I would. Yes.
And with board direction, we can make that happen.
Okay.
Yep.
Okay.
Well, overall, a real positive report card. I wish I could say it's always going to be this easy. For the rest of the year, we know it's not. We know it's not. But for right now, we don't have a lot of red flags or problems to bring to your attention.
Okay.
We like that.
Yeah, we do.
So can we,
We are done. That is all of, very briefly, next month, we intend to have international small cap managers come in and present to the board. And are we also going to talk about the equal weighted index next month, or do you want to put that off?
That's we can't get it done by next month.
Okay.
So we'll follow up in July or August.
Okay.
okay. So we want to quarterly budget.
Next would be monthly financial report, but I think there's a request for a break.
Or I can go.
Why don't you
I
go?
Okay.
Okay. So
Great.
I think it's meeting
Almost noon.
we're losing 2.5.
Why don't you
No,
take
we're
a
gonna lose
vote?
more.
Okay.
And a vote to accept the budget report.
Thanks, Greg. Really.
Thank you, guys.
Thank you.
Thank you guys very much. Thank you.
Greg,
All right.
I guess we are taking a break.
Apparently.
What's that official letter?
5-minute break.
Are we at monthly or are we?
Yes, we are. Monthly financial report.
We're only at 4, guys.
Yay.
I don't want to have to leave another meeting, by the way.
Okay, we have our monthly financial report.
Thank you, Mr. Chairman. Trustees, you have the monthly financial report. I'd be glad to answer any questions.
I have a very generic one, and it's not even necessarily directly attributable to this. Are we still negative about 400,000 a month? Is that our?
The average is a little bit higher than that.
Okay.
It's around $600,000 to $800,000 a month net negative cash flow, excluding investment returns.
Understood.
Although this month it's almost even, I see.
Right.
Is maybe an extra pay period?
Yes, there was, I believe, in March there was an extra pay period.
Any other questions on the monthly report? Okay, then we're on the quarterly budget update.
Trustees, you have the quarterly budget update, and as usual, you have 4 schedules for the quarter versus prior year, quarter versus budget, and then the last 2 are year-to-date versus prior year and year-to-date versus budget. Focusing on the year-to-date, Schedule 2A and 2B, you can see that total administrative expenses are slightly below the prior year. And the total administrative expenses are also significantly below the budgeted amount by about 12% there.
So is that surprising because of the renovations of the building?
So we did include, the renovations of the building are not in the administrative budget, or the total administrative expenses. They're on the second page of each schedule, there's a building maintenance plan line item. And you can see that relative to budget, we spent a lot of money, although we're about 1.5% under budget year to date. We think we've captured almost all of the expenses in that, at that line item through 3 quarters. So we think we're done paying on that. We did get a lot done on the building maintenance this year, as you've all noticed. The workstations, you'll recall, were not in the building maintenance plan. We did move $20,000 out of the building maintenance plan into administrative office expenses for that. That was a budget amendment in, I believe it was February that we did. So that adjustment's reflected here.
Now, is that in the adjacent office as well, or just here?
No, just us. The tenants in Suite A own their own furnishing. Those are considered furnishings. And they're responsible for their own furnishings. So,
did the building renovations include the restrooms that somehow look a little nicer and different?
yes. We did some work in the restrooms, replacing the paneling, the stall, whatever you call
Dividers.
those. Dividers, yes. And there were a number of other things. The exterior of the building's been painted, obviously, the recarpeting, the security feature for the reception area, painting, some interior painting's been done as well. Part of the carpeting involved hazmat testing and some other things. So a lot of work has taken place in the past year.
Memory serves, the next big project is the parking lot, is that?
That is correct, yes. And that's in the budget proposal for next year, yes.
And a sign out front, is there one?
That is also in the budget. We're actively working on it now. It is not as easy as you would think.
Permits?
No, getting a vendor.
Oh. And do you have to get a permit from the city for that?
Yes.
You have to, there is permitting involved
Yeah.
to an extent.
Yeah.
So,
Just don't do a big illuminated one and they won't notice.
You're not gonna have a traveling return on investment rate there, then.
You can get a sign like across the street.
Not to belabor the point, but are you just looking for a wood sign? I mean, nothing.
So it's complicated. So with the city of Ukiah, and this is a little bit off topic, this relates to the budget proposal more. Maybe I can come back to it when we get to budget proposal. That would be more appropriate.
Okay, so we've seen and discussed the quarterly budget report, now we go to the audit and budget committee.
So the audit and budget committee met with the chairman's pleasure. You have an overview of the budget proposal that was recommended by the audit and budget committee for adoption by the full board. I'll just hit the highlights of that. No changes in personnel other than expected salary increases. I should note that the confidential unit will potentially be bargaining during the fiscal year, and all of the employees, save myself here, are in the confidential unit. So if there are negotiated changes in personnel expenses there, we'll have to do a budget amendment to capture that. Administrative, we have a number of things happening here. The Audit and Budget Committee recommended approval of some updated furniture for the boardroom, actually getting us a conference table befitting an organization of our stature, and something other than folding chairs for the gallery and visitors here. We also included funds for some laptops, 2 new ones and a replacement, because this one's exceedingly old. We've increased, there's an increase in legal expenses as well. We have some projects that we expect to involve tax counsel and potentially fiduciary counsel time to work on.
So that jump is not necessarily related to our contract with Sonoma.
That's correct.
Something else.
That's correct. Yes, it's a totally different project. We actually, I believe there was a small decrease in the contract with Sonoma County in the legal expenses because we continue to use less and less of Jeff's time, although we expect a slight increase in the costs, but we're using less of his time. So, board expense, I did want to point out we do include an item in there for a strategic planning offsite. We have that scheduled tentatively for September. The disability is what it is. In technology, we do include a $20,000 item in addition to our contracted fees for change requests. We have these come up from time to time where we want a change to the system to meet our specific needs, and we pay LRS on an hourly rate for those changes. We always get a proposal from them of this will take X number of hours before we do that. Investments included in there is the potential for us to have a separately managed account for an equal weight index. Don't know if we'll end up there, but that's a possibility. And then the capital improvement plan. Here we've got 5 major projects, parking lot being one of them. The exterior patio for Suite A is a security concern. We've had some trespassers who've accessed the area and threatened security of the building. One of them started a fire.
What? Inside?
It's outside, but it's under the roof line of the building. It's very peculiar. We've taken some intermediate steps, but we need to take more substantial steps to limit their ability to access that.
Orchard Avenue's the main, you can watch the police log. There's more activity on Orchard Avenue, transient problems than any place in the city.
Yeah. Third project is landscaping and irrigation repair. We need to do some work there. The audit and budget committee we had a number, but they wanted to scale that back, and so that's included in here. Signage is included here. We've talked to some vendors. We were working to try to find someone, and apparently there's no one local that the county works with that's willing to do signs for us.
What about Fort Bragg? So there's somebody.
There's Rick Sachs does signs in Fort Bragg all the time.
Yeah.
Okay.
Good guy.
We've been reaching out. I wasn't aware of that vendor, but we've talked to some folks out of Santa Rosa.
I can give you the contact.
Okay, that would be great. There is, with the city of Ukiah, there is a sign permit process. And for a multi-tenant building, there's actually, you have to have on file a sign plan, which is what your signs will look like. And if you want to change your sign plan for a multi-tenant building, you have to submit that for approval. So we're doing work now. We've got a potential vendor who went and pulled our plan and is working up some potential options for us within that plan. So the last thing is making some improvements in our kitchen, break room, closet space to put a little more storage in there and make it a little more functional for the staff. So total for all of those, we've budgeted $47,000. So with that, I'll stop there. There is another item from the Audit and Budget Committee, but I think it should be handled as two separate motions. Mr. Chairman, I'd stop and defer to your judgment if you...
There's a separate issue?
Auditor.
Oh, okay.
So the question is real in the weeds. Your audit and budget committee rejected your landscape and irrigation request.
They did not reject it. We had asked our current vendor for an estimate to replace everything.
Yeah.
And they gave us a number that was significant, and the committee was uncomfortable with that large of a number, so they scaled it back to a lower number, which was kind of my thinking was, what's the worst case scenario? Put that out there for the committee to discuss. What are you comfortable with us spending? And they made the recommendation that they were comfortable with $10,000 towards landscaping this year.
So I would offer free consulting services to what you're rejecting.
Okay.
All right. Good job.
We also rejected buying new chairs for here.
Oh, yes.
We thought these would
Suffice another year.
We kind of had questions about the table, but it's going to give us more room. And if we sit here today and we're pushing things around to get people in and...
Well, the leg things are
The legs.
Yeah, it's hard to get, yeah.
So we didn't go with the chairs, but we did go along with the new table.
Thank you.
And so the table will not
I'm
have,
not
probably
sure.
have, be,
It will have supports of some sort, but
But
it's
more in
not
the
going to
middle.
be 6-foot
like
tables.
this.
It's
Yeah.
going to be a continuous table.
right,
With center support, so.
right.
Yay. I've straddled the legs now for over 2 years.
Okay.
Is it a longer table?
A little bit longer. Just barely.
Some of us don't have to have her back to the public.
Are you looking for a motion to adopt it?
The Audit and Budget Committee did adopt a motion to recommend approval of this to the board, so it does come to the board in the form of a motion.
So that we don't have to do anything but vote on it.
That is correct.
I think we should vote by roll call, Judy.
Okay. Ms. Shatmeyer?
Yes.
Mr. Sullivan?
Yes.
Ms. Cavanis?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
And Super Chair Jordan?
Yes. Okay. So now the audit?
No, there's one other item on the Audit and Budget Committee report. On the last page of the materials for the Audit and Budget Committee report is a report related to the Financial Statement Audit Services RFP. You'll recall several months ago we issued the RFP. We received precisely one response, and it was from Brown Armstrong CPAs.
I'm sorry.
Our current auditor because they were acquired by Clifton Larson Allen, notified us that they would not be able to get the public pension group within Clifton Larson Allen engaged in time to submit a response. But they're more than happy to consider a one-year extension if we didn't want to change auditors. I was not overly enthused with that response. If you can't bother to bid, why should I think you're going to bother to be care very much about our business? So,
And Brown Armstrong does, what, 10 or so of the 20?
a lot of the 37 Act plans.
Right.
They have a significant group. Stan and I had a video conference call with them. We reached out to references that Brown Armstrong did not list on their list of references in the response, and everything we got was in glowing terms. So the Audit and Budget Committee recommended that the board hire Brown Armstrong as the financial statement auditor for the 3-year term.
Okay, so we do have that committee motion on the table.
I want to add something. Should we, in the interest of being above board, mention the, are they being sued by the city?
Yes, there was one issue in the RFP. One of the questions is, have any claims been filed against your firm? There's an issue with Brown Armstrong where in the city of Pasadena, an employee of the city of Pasadena has been charged with fraud or theft or something, and it was something along the lines of he wrote 19 checks.
It was 180 checks over 10 years.
Yeah, 180 checks over 10 years, multiple millions of dollars, and the city is suing. Brown Armstrong was the auditor for some period of time there.
We're not catching it.
And they didn't catch it, but when it's 19 checks a year and the city of Pasadena writes thousands of checks a year, the likelihood of getting one of those in their sample is relatively small. And Stan and I on our video conference with them did ask specifically about that, and they said they feel very good about their position as they had a recommendation in their audit about controls, not necessarily that specific individual, but about controls in general and processes. So
That's horrible. A trusted employee, clearly.
and they were checks written to churches,
Oh, wow.
as he was a part-time pastor as well as being a city employee.
God bless, right?
The church of my vein.
So,
Well, we do have a motion from the committee, and so I guess roll call.
Ms. Shetmeyer?
Yes.
Mr. Sullivan?
Yes.
Ms. Cavanis?
Yes.
Mr. Walker?
Yes.
Mr. Knutson?
Yes.
Ms. Harris?
Yes.
And Chair Jordan?
Yes. So that brings us to the discussion possible action regarding budget authority requests.
thank you, Mr. Chairman. Trustees, you have before you a request for budgetary authority, and this is kind of an odd thing here. So Stan is working on his what's called the CAE charter, the Certified Alternative Investment Analyst Charter. It is the second most significant professional designation in the financial world. CFA is kind of the very premier. CAE is quickly developing into a very important designation right below that. Stan passed level 1 earlier this year. Is planning to work on level 2. Anyway, I won't tell you all about it. I recommend that the board approve the association paying the level 2 exam fees and related study materials for Stan.
I move.
I'll second that.
Okay, we've got a motion, a second. Richard, you have?
I would have thought that, other than congratulating Stan, could have put this on consent.
Yeah.
then we wouldn't know about it. Well, we would.
The whole reason I bring it to the board for specific action is that there's not clear authority that this can be done. And because there are funds in, under the MOU, it's a little bit of a gray area. And if I've learned anything in my career, it's don't rely on the gray area. So.
Okay.
Not do it.
Yeah, we don't, well, small is a small amount. All in favor?
Aye.
Any opposed? Okay. All right, now we're on to,
Trustee education,
Yeah.
travel policy.
Yeah, just add trustee instead of trustee.
Capitalizing, it looks like.
Yeah.
So there are a few changes, a few thematic changes that I'm proposing in this policy. It's capitalizing a lot of words, and then there are limits inserted in a number of places within the state of California that I've stricken. I don't think we need to necessarily be limited by the geographic boundaries of the state of California.
Has the county changed their policy? That there was a policy you needed board approval to travel out of the state.
so policy that I'm aware of is if a supervisor was traveling out of state, I think other county employees travel out of state without board knowledge.
I think my understanding of the current county policy is that the CEO's office needs to approve it before you do that, but we're quasi-county.
Well, they approve everything anyway. I mean, any travel, the CEO's office has to approve, so.
So if you're gonna capitalize committee, I would suggest you capitalize the word member after board on J on the second page. You could ask John McCown for an opinion on
An English major.
You're on the second page.
that. The very last line.
Oh, okay. Noted.
The word member should be capitalized. This one. Nothing substantial there.
Oh, one other change on page 5, under the trustee orientation materials, says that the retirement administrator is supposed to give copies of all these documents to a new trustee. I changed that to let them know where to find all those, moving more towards the electronic age.
Yeah.
Could you give me an example of what we might be interested in out of state? Is there a national association meeting or something like that we might?
There are absolutely national associations. The two that I'm aware of, the National Association of State Retirement Administrators, actually 3. The National Council of Teachers Retirement and the National Council of Employee NCPERS, I can't remember, Public Employee Retirement Systems.
Council of Institutional Investors, I mean, they're.
Well, I'm sure there's a million. I was just
incredibly
trying to get a handle
high
on my own mind. What,
right?
If we're going to remove the reference to the state, what
and
where that might go.
There's also, from time to time, there may be an investment manager that hosts a conference that a trustee might have interest in that would fall outside the state of California. It doesn't seem to me like any of our trustees are going to get crazed about travel.
Well, we're spending, if you look at this year's budget, we're spending well under the budgeted amount.
If our travel budget did blow up later, cause a problem, we can always review this policy?
Absolutely.
Right, okay.
Absolutely.
Okay, so I guess need a motion to adopt.
I'll move to adopt.
I'll second.
As amended with the one change suggested, the capital letter.
Actually, you have to go through the document.
I found another one.
We'll do
too.
that.
Yeah.
We'll do that.
Quickly.
Okay.
And it's on.
Okay, Just all those in favor? All those in favor?
Aye.
And I'll note that as far as I know, none of the supervisors have traveled out of county, out of state in recent years because it's never been on the agenda. So that county expense.
Didn't happen.
Yeah. Where you're kind of hearing with the cannabis issue is people were heading to Colorado, not here, but in other counties, they were actually going to Colorado for training, for finding out what's going on and that kind of thing. So kind of as an example, yeah.
As it happens, people in Mendocino County don't have to travel that far.
Exactly.
You ride a bike and.
Right.
You don't go to NACO anymore.
I don't think anybody's gone to NACO in several years. Okay, right, so now we're on to discussion possible action regarding 2001 board work plan.
All right, trustees, you have the work plan, and I'll refresh your memory. Everything in red is a change or something new, and that's where I'll focus my efforts. I realized, and I will apologize, I'm a month tardy in doing this. I generally like to do this the month after a quarter end, so this should have been done in April. The external auditor RFP was not on here last time. That's obviously complete with business earlier today. The strategic planning offsite, our dates are September 13 and 14. Please make note on your calendar. I'll remind you again, the community presentations, if you know of any other groups where I could go and make a presentation, please let me know or connect me with people. The conference presentations, the association does have 2 moderators at the spring SACRS next week. That would be Jerry Harris and myself moderating breakout sessions. Added on page 3 of the work plan, added are the experience study and the actuary contract. Add those after the fact, just so we can cross them off. Those are both done. As of today, the emerging markets search is done. We've also finished the 2017 property maintenance plan and the asset category portfolio review. Two items under investments still in process are the international small cap search. We'll finish that next month. And then the equal weighted search, as Callan indicated today, not July, but that'll be in the early third quarter of the year. The next 2 pages are our list of accomplishments. Just having to say that it's 2 pages.
Still good.
Achiever is one of my strengths, so check marks on things is a driver. So
Why do some have happy faces and some have check?
those are the ongoing.
Okay.
A check mark means it's
Okay,
done. We don't
okay.
have to do it again. A happy face means it's ongoing.
Okay.
So, but we're staying green. With that, I'd be happy to answer any questions. If you'll indulge me, we're moving through this rapidly enough. I hope you'll indulge me for just a couple of minutes. I think I've mentioned previously that staff has gotten together and come up with a list of projects for us to take on. It's an extensive list. It's going to require a lot of time. We're talking years worth of projects. My best estimate is we've got about 5 years worth of projects that we've identified that we need to take on. So we have a lot of work to do. I intend, and we're forming it, we're doing a lot of work on it, but it will look very much like the board work plan. Everything that made it from the ideation phase to the list phase had to get categorized within one of the objectives set forth by the board, such as 100% success rate in delivery of monthly retirement benefits or 95% client approval rating. So everything's categorized under there. During the offsite, my design is that we would be sharing some of that with the trustees and having a conversation about what these different projects are and why we think they're important and how we see them lining up with your objectives and strategies. So I do expect coming out of the offsite, potentially adding some things to the board work plan. It's taken us about almost 2 years now to work through a lot of the issues that we identified at the last offsite. We cleared a lot of underbrush, and now I think we can take on some more things. So we'll be having that discussion in September. With that, I'll shut up.
Okay. Good to know. All right, so then we're on to the SACRS, looks like, discussion of possible action regarding MSAR vote delegate for SACRS.
Direction to the voting delegate. So, if I may, Mr. Chairman, we have a policy that determines who the voting delegate will be. And the policy directs that the voting delegate shall be the chair, the vice chair, and then the members in order of seniority. So by policy, the voting delegates for MSARA at SACRS will be those trustees that are attending, Ms. Cavness, Mr. Knudsen, Ms. Harris, and then myself as a fallback position. So we've already notified SACRS by our policy that those will be our voting delegates. The issue before you here is what direction on two separate issues, the bylaws and the board of directors elections, will MSARA give to the voting delegates. And just to be clear, under our policy, the voting delegate can only vote as directed. So if there's anything that takes place at the meeting causing a change in anything, as we've seen sometimes in the past, our voting delegate can only vote as directed by this board. So,
Just for information, I won't be there Friday morning to vote on it.
Ooh, kidding.
my apologies.
I thought Tim was out of line.
I think battling me. No, I will not be there Friday morning. I'm leaving Thursday night after the meeting for the presentation.
Okay, so do you want to go over the two main items?
The two main items are the amendments to the SACRS bylaws. There are changes to the bylaws.
Do you know which one of these three it's in?
So the link under amendments to SACRS bylaws shows one page of language. That is all new language added to the SACRS bylaws, and it's membership code of conduct. It's very standard information there. I feel very comfortable with that. If you open up the document under the business meeting packet, you get a full listing you get the full business meeting packet. And I did not jump to the page where the bylaws are, but I can get there. Not quite quick enough, but.
Did they not have a code of conduct prior to this? Or?
That is correct.
Okay. Dare I ask why we need one now? Is this just best practice, or is there some
best practice?
issue
Well,
with it?
there is a California code directing entities such as MSARA that we have to have a code of conduct and or code of conduct policy and a code of conduct. Losing the words. So we added that earlier this year or late last year. I can't remember which. The statute's been there for a while, so my guess is, and I'm speculating here, SACRS didn't have it. Someone said we need to have this, so it's being added. I'm very comfortable with it being added to the bylaws, and I would recommend the board approve that. The other bylaws changes, if I can find them. I did review, I'm just blanking on what they were. Changes to the program committee. I would recommend the board approve those as well. So those are on page 69 of 92 in the business meeting packet. It's expanding the membership of the program committee. The previous language was between 4 and 18 members. It now says not more than 25 members, and gives some outline of how those membership shall be distributed, and some other changes. So
The reason I ask is that, I mean, on the surface, it's, who's going to argue against, prohibiting hostile, degrading, humiliating, or offensive conduct. The flip side of this, and why I asked if there was, something going on behind the scenes that maybe we didn't know, is, I can also envision a scenario where if there's some, disagreements that somebody who has an unpopular position perhaps might be accused of being hostile and then forced out. But that's not what we're.
I don't think that's
Okay.
what's at play here. I mean,
It sounds like there's specific criteria for what would define a hostile environment. I don't think it's that broad.
right.
Where-
I think for SACRS to take any kind of approach to take action against a member in terms of a member of a board of member or staff of a board of retirement, you would have to do something pretty egregious.
Right,
They're
fair
much
enough.
more
Yeah,
than-
I don't disagree. I just wanted to
Yeah.
throw that
I mean,
out.
it's reasonable people. I think this is just we need to have a code of
Pro forma.
conduct.
All right, fair enough.
There have been incidents in the past at SACRS conferences that I've heard stories. I'm not personally aware, but I've heard stories of,
So we have recommendations to support, to gather both the bylaw amendments.
I would recommend approval.
So moved.
Second.
Okay. All those in favor?
Aye.
So the voting delegates are so directed. And then we also have who we're supporting for the election. And
How come the slate's not on here though, right? I mean, we had it was on last month,
It is on in the packet.
because I saw all the
we
letters.
do see a familiar name.
There's a,
Oh, where was it? Okay, that's what I
Right.
didn't see.
The,
Okay, so we just need to,
it's on here somewhere.
yeah, and I move we adopt the recommended slate with Catherine's name on it.
And do you want to grant authority to the voting delegates that if Catherine's name is on an alternate slate, that they have the authority to also vote for her on the alternates? I mean, you just said that in
Yeah.
the meeting that something could happen. I mean,
Yeah.
what is this weird letter?
There's drama.
Which weird thing?
Drama.
There's
There's
a lot of
a lot of
weird
drama with SACRS.
There's a lot of weird.
Larry Walker's letter.
Where he basically has taken his name off.
Right, but he also
As treasurer.
references, what he talks about. So all of a sudden we have an ethics thing. This guy sounds like, wow, we don't want to.
Page 74 of 92 is where, at the very top, is where you would find the SACRS nominating committee recommended 2017-2018 final slate for officers of SACRS.
Okay, I was looking at the other ones. So.
74 of 92.
So, but I gather what we really want to do is authorize our voting delegates to vote for the recommended slate where Catherine's a member and have the flexibility should there be an alternate motion at the meeting. They also have flexibility in voting for Catherine on the alternate, should there be an alternate.
Well said.
Yeah. So someone want to make that motion?
I move
I'll second.
Do they follow the procedure where they'll announce the slate and then ask if there's any nominations from the floor? Are these write-in candidates?
Nominations from the floor, I believe, are not accepted at the meeting.
But these three could be substituted, is that?
So,
What page are you on? What page is that?
74. So Art, somebody could recommend Art Goulet take the secretary position? Is that? Last time I was there, we had a whole different position here, where they were trying to get rid of the president, and if it's something like that, be prepared to vote for about a day and a half.
I don't know that it will be, it will be very similar. I think the logistics of it are going to be similar to what happened that year. But there's going to be a lot of confusion, I believe, because the write-in candidates, there is a write-in candidate. The same person is written in as a candidate for secretary and for treasurer.
But then also on the recommended slate, Harry Hagen is on the recommended slate as
And he's
a
on the other
treasurer.
one.
But he's also as a treasurer on the write-in candidate. He's
Because he
both.
wasn't on the original one.
Yeah.
And
because
that's-
Larry Walker was there,
Right.
and now Harry Hagan is there.
And that's it due to the timing involved
Okay.
with Mr. Walker resigning from the board of directors, withdrawing his,
And now Art Goulet's gonna do write-in for treasurer and secretary. When he could have been treasurer. He was offered, from what I understand, he was offered the treasurer spot. And that's why Larry Walker stepped down, so that he could have that spot, and he said no. And then now he's doing secretary or treasurer. So there's definitely some drama going on here.
Okay, but do we have a motion with that flexibility?
Yeah.
Yes.
so if I might restate the motion is to direct the MSARA voting delegate to support the SACRS nominating committee recommended final slate or any other slate where Ms. Cavness is the candidate for secretary.
Yes.
Is that, just making sure I captured the motion. Richard?
And then
Why
she
do you
motions-
include the word slate? Why not just say Catherine for secretary, period?
Well, the other people we want to vote for too. Harry Hagan, he's the treasurer tax collector in Santa Barbara County. So he's good.
Mhm.
And Dan McAllister is treasurer tax collector in San Diego County, and he's been good.
Yeah.
And so, I like, the slate is good.
And I guess I'm just saying that because if people are gonna do parliamentary maneuvering there, it might come up as an individual nomination or whatever, and not as a slate.
So if you wanted to give the maximum amount of flexibility, you could restate the motion as the voting delegate is directed to vote for Dan McAllister as president, Gabe Rodriguez as vice president, Harry Hagan as treasurer, and Catherine Cavness as secretary.
That's good.
And that way, however it comes up,
Because that's all you're going to.
those are your four names that the delegate will vote for.
Okay,
Yeah, if there's any.
Yeah, that's
conflict,
fine.
Does that?
because that's what, she just wants to be secretary, so.
I wanted to start at the bottom.
Yeah, she does.
The bottom level is secretary.
Yeah, and she did,
You wrote a beautiful letter.
Yeah.
Thank you.
yeah, so no, I think that's good, and then that way, that's good.
Well,
Okay, all those in favor?
Aye.
Okay, great. So now we're on to retirement administrator report.
I have,
Oh,
who is, since you're not going to be the voting delegate, who is?
You are.
Me?
You're the vice chair.
But I can't vote for myself.
Yes, you can.
You're voting on behalf of
I've done it.
the board of retirement.
Richard's
Oh.
done it.
I've
That's
done it a
so-
couple of
Jim's
times.
done it.
Voting. for-
Dan's done it.
Okay, whatever.
Yeah. No, you are vice chair.
If you step out of the room during voting,
What?
your backup would be, since Tim won't be there, would be Jerry.
Okay, thank you.
And it's my plan to not be there on Friday morning as well, so.
Oh, come on.
And I would recommend either one or both of you be there, because if it goes on like it did when I was voting for president,
Right,
literally, they did a roll call of the voting delegates
right. I was there.
at least a dozen times, maybe 20 times.
Oh, are you kidding?
Oh.
That's horrible.
It got really crazy.
Yeah, it was. And if you're not there, you don't vote. You don't wait for you.
And where are you gonna be, Tim?
I'm leaving the conference Thursday night.
Gee, maybe I am too.
Okay, we're on to retirement administrative report. We're nearing the finish line here, guys.
Yes.
Hey, you need any bumper stickers or anything? Badges?
Thank you, Mr. Chairman. Trustees, you have the report. We did receive our GFOA certificate. Please mark your calendars for September 13 and 14. We'll get you more details as we line out all of the logistics. I didn't want to start working on logistics until the budget was approved. It's time for my evaluation. I will be sending the documents to you, very similar to last year. The chair has asked that you have those, your input to him by June 2nd, so that he can coordinate all that in time for the June board meeting. We are having the building appraised in accordance with our investment policy. I've reached out to a number of appraisers and identified the best deal we can get. Just wanted to make you aware of that. And then stand past level 1 CAE, but I already told you that. So I'd be happy to answer any questions as long as you don't make them too difficult.
Okay, seeing none, we're adjourned.
Okay, thank you.
Thank you.
I'm not taking these because I don't need any more paper on my desk.
Yeah.